He's making his investments talk. Business Standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business Standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of becoming a brand. Business Standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business Standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business Standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of becoming a brand. Business Standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of becoming a brand. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of becoming a brand. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of becoming a brand. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of becoming a brand. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of becoming a brand. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of becoming a brand. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू to reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business Standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है। To reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business Standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है। To reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of becoming a brand. Business Standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है। To reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business Standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है। To reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business Standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है। To reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of becoming a brand. Business standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of becoming a brand. Business standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है to reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है. म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स. रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली.
She has ambitions of becoming a brand. Business standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं. बैलेंस और फ्लेक्सिबिलिटी जरूरी है. To reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है. म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स. रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली.
He's making his investments talk. Business standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं. बैलेंस और फ्लेक्सिबिलिटी जरूरी है. To reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है. म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स. रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली.
He's making plans for an early retirement. Business standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं. बैलेंस और फ्लेक्सिबिलिटी जरूरी है. To reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है. म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स. रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली.
She has ambitions of becoming a brand. Business standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं. बैलेंस और फ्लेक्सिबिलिटी जरूरी है. To reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है. म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स. रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली.
He's making his investments talk. Business standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं. बैलेंस और फ्लेक्सिबिलिटी जरूरी है. To reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है. म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स. रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली.
He's making plans for an early retirement. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of becoming a brand. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of becoming a brand. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
Hello everyone. Welcome to the penultimate day of Business Standard BFSI Insight Summit. Today is all about mutual funds. But before that, let me remind you, the event series concludes tomorrow with a fireside chat with RBI Governor at 4 p.m. and a panel discussion with some of India's biggest bankers. Meanwhile, leaders of mutual funds are with us today. We will start the afternoon with a keynote by Ms. Usha Thorat, Chairperson, Mutual Fund Advisory Committee of SEBI, followed by MF heads discussing who needs mutual funds. We will then take a very short break and come back with the second session around 6 p.m. Buy, sell, or hold. Hear it from the horse's mouth in our CIOs panel. For both the panels, we will take a few questions for the panelists after the initial discussion. Please send them in the questions box on the website. For social media conversations, use the hashtag BS_BFSI. May I now request Mr. Tamal Bandyopadhyay, our consulting editor, to take over.
Thanks, Manish, and hello and welcome. Welcome back, rather, to the 8th day of Business Standards, 9-day, 11 episode, 2-part, I would call it BFSI Mahotsav. First part got over just before Diwali. We took a Diwali break. Then we came back yesterday. Yesterday was an insurance day, and today is the market day. Yeah, the theme is buy, sell, or hold. I think everybody wants to know. So it'll be an exciting panel discussion from the India's best and biggest fund manager and CIOs. Probably 85% of the mutual fund industry is present there through their CIOs and the fund managers. We will take questions, as Manish has said, but please don't ask for any stock tips. That won't be entertained. Rest, everything is fine. And before the discussions, we'll have a keynote address. Former RBI Deputy Governor, Ms. Usha Thorat, but Usha is not here in her previous capacity. She is the chairperson of Mutual Fund Advisory Committee of India's market regulator, SEBI. Welcome, Usha, for your keynote. Yes, over to you.
Thank you. What has happened again? Okay.
Yes, perfect.
Yeah, thank you very much, Tamal, for inviting me for this quite an interesting summit, the Business Standard BFSI Insight Summit. And I really admire the number of sessions that you have organized and culminating in tomorrow's session, which everybody is looking forward to. At the outset, like Tamal said, I'm not here in my previous avatar as former deputy governor, but now for the last year and a half as chairperson of the Mutual Funds Advisory Committee of SEBI, which has been a very, very interesting and a learning experience for me, and really trying to understand this. So I must thank Tamal for this opportunity, and also to thank my friends in SEBI and others who have helped me in putting this whole thing together. So basically what I want to do is I just want to give some facts about mutual funds, then raise this issue of why mutual funds, how has it been helped, how has the industry innovated, and where does the industry go from here. So first, some set of charts. Being an RBI person, you really can't do without data. So this is from an RBI source, which shows the share of, this is the stock position. It shows the share of different financial assets in the households as a share of the total household financial assets. And if you see mutual funds, they have been steady at around 7 to 8%. And the share remains around that level as compared to bank deposits, which is between 50 and 54%, and life insurance, which has moved between 23 and 24%, and deposits with cooperative banks, which is around 5%. So there's been, I mean, this is over the last 3 years, but this has not been really very different from previous periods. The financial flows, they show a little more changes. So if you see this chart, you'll find 2016-17, mutual funds had quite large inflows, and that was the year in which currency was a negative and bank deposits was a huge amount. That was a year of demonetization. But going forward, yes, in the recent period, we've again had a little bit slowing down of the inflows. So this just puts everything in a little bit of a perspective. But when you just look at this is from SEBI, this is the growth in the industry, the assets under management from about 1 lakh crore, 37 lakh crores. It's a huge increase in the 20 years since 2020. The number of folios has grown about 3 times, little less than 3 times. But this does not really reflect the investor base, which is definitely much less. If you see the total assets under management, you'll find that retail investors, when you say individual investors, it's about 55%, and institutional investors about 45%. So actually, retail investors have been around, it was 27% in March 12, but around quarter. So that means of the total assets under management, 25% is really from what we call really retail, and 30% from high net worth individuals, and 45% from the corporates, institutional investors. When you the share of equity, debt, and hybrid, you'll find that roughly 45 equity funds is around 30%, and about and the debt funds is quite significant. But this is when you look at the total. When you look at the breakup, then one finds that in debt-oriented funds, the share of individuals is just 37%, whereas the institutional share is 63%. And in equity-oriented funds, you'll find the individual share is 88%. And this is just what one would expect it to be. So, and in the liquid and money market segment, again, the institutional investors are quite significant. So, if you also compare from where these funds are coming, and there's been more recently an attempt to go beyond the T30, the top 30 centers, and go to the beyond the top 30, which is the B30. So it's interesting here that out of the total assets, AUM, the equity assets from B30 between the period April 21 and September 21 was 26%, which is quite interesting. And the non-equity is 12%. Again, it reflects the fact that the retail investors, who are probably more significant from the B30, are really more putting money into mutual funds because of equity and not really debt. So if you look at total all summarized facts about the mutual funds, total assets under management, 37 lakh crores, 15% of GDP. Countries like US have 60%, some other countries have 45%. But we must realize that India, like many European countries, is a bank-intermediated financial system. So the share of bank has been very high, whereas US has been a non-bank intermediated financial system. So apart from that difference, the share of mutual funds as a percentage of GDP at 15% is not really low when you look at many of the other emerging market countries. But definitely there is a potential and there is a scope for increase. 9% of household financial assets in mutual funds, which was about 17 lakh crores in March 21. And here is where the penetration, we have to say, is really low, as I had shown you in the initial thing, 7 to 8 to 9%. This has been the history of the share of mutual funds and their penetration in the household financial assets. So number of investors today is only 2.2 crores, and this is a matter which we've always been concerned about. And mostly this is in the T30. And in the B30, perhaps that is where the potential exists. And even in the T30, probably we do have a significant potential amongst different other classes of investors whom we have not yet touched. Total number of folios I mentioned. Individual investors, 55%, institutional 45%. Within the individual investors, 40% are retail and 60% are HNIs. And out of the total assets under management, 35% are in equity funds, 40% in debt funds, and the 12% in balanced funds. And as mentioned earlier, the share of retail funds is higher in equity. Now, why mutual funds? Clearly, mutual funds are an ideal way of getting the benefits of investing in the stock and the debt markets for a retail investor as per his personal preference and ability to take risk. It obviously, and it gets the benefit of diversification, you get the benefit of expertise, professional management, and that's how we have today the CEOs panel and the CIOs panel, because here are the experts who are actually going to make money work better for an individual who will not know exactly where to go directly. And even if he does, he can probably just take one stock. So you'd have the benefit of having a variety of stock to be able to take, variety of debt to be able to take, according to your personal preference, your lifestyle issues, the life stage at which you are. So mutual funds are really useful from a retail investor. And he has to know his personal preference and ability to take risk. Clearly, that calls for a certain amount of financial literacy on part of the investor. It is a very important source of capital for growth in the corporate sector, and it has helped in growing and developing the bond market. And like I said, we have had a fairly significant concentration from the banking system, and the mutual funds are able to become a source of supply, savings, which are going directly into the debt markets. And that is where, at least there is a diversification benefit where it's not entirely bank concentrated. The investor base, the savers base also gets diversified. And when we have lots of foreign institutional investors coming into the country, we also have the domestic institutional investors, which are really the mutual funds and other institutional investors who really provide a very good counter foil, not necessarily, but at least they are a stabilizer, a counterbalancing element. Mutual funds have got significant voting power and they act as a watchdog for minority shareholders. And this is a very, very important role that mutual funds need to play and have also been playing. Of course, they also, although mutual funds were really not intended for institutional investors, but what has happened in India is they become an ideal way, liquid funds and overnight funds becomes an ideal way of managing cash and liquidity. And in a way, what this does also is adds liquidity to these money markets. It adds liquidity to the bond markets and also helps the bond market grow. So mutual funds do play a very important role in the system. And it is, expected that the Indian industry will also, reach out to its full potential. Now, regulation has been really, if one looks at it, there's been fairly a significant overdrive in the regulation in the recent period, and very importantly so. A number of things have happened in the recent past, over the last 4 or 5 years, which have actually transformed the industry and made it to one which was earlier favored an upfront commission, very much distributor driven, based on churning and turnover, to one that is focused today on investors' interest. Number of measures have been taken, just simple product labeling, being true to label, you get what it says, much greater transparency on performance and risk, introduction of riskometer, introduction of various ways in which performance is calculated and communicated to the investor, the emergence of a potential risk class so that the investor is very clearly aware of the risks that he's taking when he's investing in a mutual fund. A number of other measures which have gone for cost reduction, the cap on the expenses ratio, direct plans which have now become very much more popular compared to regular plans, digital platform taking advantage of the ecosystem changes which have happened. There is definitely much more recourse to directly going on to the digital platform for investment, redemption, and various other measures, including KYC. And the prudential measures have been extremely important. Certain events in the markets have obviously driven these, but they have been extremely important. Liquidity clearly is one very important one for open-ended funds, particularly when, and there are valuation norms have been now very much streamlined, principles have been very clearly set out. On inter-scheme transfers, there are very clear guidelines and rules. There is a clear policy now for segregated portfolio, and this can really, sort of separate the assets which are slightly under doubt from the good assets. Exposure norms for unlisted and credit enhanced debt. All these measures have been taken to make the debt funds particularly much more stable and not lead to sudden kind of shocks for the investor. And these have been measures taken by the regulator in the last couple of years. Some of the other measures which are much more recent have arisen out of the various experiences with crisis when it's found that there's hardly a backstop for even good quality bonds, and there is no a limited purpose clearing corporation for repos and corporate bonds. These are some of the market microstructure measures which SEBI has initiated, and these will probably come into their own over the next couple of years. A new digital platform is also on the anvil for investors, making it very easy, and a number of issues on governance, strengthening the trustees and giving them some, staff, mandatory voting by mutual funds, disclosure of their voting, especially mandatory voting on matters relating to related party transactions, alignment of interest of the management and the in the skin in the game in the bonds itself. These have been some of the governance issues which have attracted the attention of the regulators, and all these have enabled the industry to grow. But clearly, there is there's much more opportunity and potential. The industry itself has taken certain initiatives. I think the SIP is a really significant initiative, and it is in September 21 alone, the monthly SIP contribution was almost 10,000 crores a month. There is now a consolidated statement that's available, and it's been there for some time. The MF Central is a very convenient, it would bring in ease and convenience and speed of service, and currently it gives you your holdings, but it'll soon migrate to complete online operations. There's a daily NAV even for closed funds, and there's much more awareness of mutual funds through the campaign that AMFI did of mutual funds a year. The next stage of growth. There's been an interesting report, the AMFI BCG report, which showed with different strategic ways of achieving a large distributorship in the T30, in T30 itself within certain categories of investors, and in the B30, definitely the potential is going to be quite huge. I think that there is a lot need for certain strategic thinking on the part of the AMCs to look at individual investor preferences in terms of their life stage and requirements. So I think simple products, because making it very complicated on offering too much choices, maybe simple plain vanilla products to suit certain typical types of investors is something that many investors, might really look forward to. Today, they do go by the name, they go by the sponsor's name, and then they do invest. There is this lot of not a very clear awareness amongst individual investors of different types of products. However much one talks about true to label and simple, I think the products need to really convey to an individual investor according to his or her expectations. There is, of course, this is not completely happened. It's happening, the unified and simple digital access, taking much more advantage of technology. Perhaps here is where there's been some lagging behind. Marketing and awareness in the local languages. Also, in India, the passive schemes and ETFs are really not that important, but these are globally outweighing other schemes. And these are probably with a low cost, and especially when you look at various studies which show the performance versus benchmarks, it would seem as if even with the kind of expertise we have, there's not been a uniformly overperforming the benchmarks, which would warrant the higher cost. So there is a clear need for mutual funds, asset management companies to look at the scope for passive schemes and ETFs, which have done very, very well. So, and here it's a really game of volumes. And I think margins may be lower, but the volumes game will definitely take this share from something like 8 to 9% to something like, I would say, no reason why it should not really reach 15%. But for that, clearly the distribution mechanism is something that will have to be thought about, because unlike insurance and banking, where you have a outlet, much closer to the investor, and these are all more kind of touch and feel kind of investors. I think there should be a need, particularly when you look at different kind of generations and coupled with awareness, to be able to take advantage of partnership channels and other ways of reaching out to investors, which will, for simple schemes, it will really increase the volume. So I think here some thought perhaps will need to be given. Some issues for discussion. One issue which I have been sort of thinking about and is this whole institutional structure. You have, and it's got a lot of legacy, going back to UTI, you have the sponsor, you have the AMC, and you have the trustee. Now, no doubt this structure has served well, but one really has to ask this question, who is actually responsible for what? The AMC, which is really clearly the biggest player in this, and as AMCs have matured, and many of the AMCs here are mature AMCs, where the sponsor is not that active and role, it's the AMC board itself, which is a listed company, taking a very responsible role. Now, the accountability and the responsibility for investor protection and investor interest, there is no reason why this cannot be the AMC. Currently, this is the responsibility of the trustee company. And the AMC, in a way, is, manages the whole thing and is responsible for the execution. But I think there is a kind of a need to understand what is the role and responsibility of the AMC, what is the role and responsibility of trustee. SEBI entrusts everything, it is the trustee who's overseeing the investor interest and in a way accountable for the investor interest. But is there a need for looking at the structure itself and the role and responsibilities? It should not be the case that accountability falls between the stools. In particular, I would say that if SEBI is, has to take certain, has to fix certain accountability and responsibility, then it cannot be the case that its orders can get struck down because it says that clearly AMC is responsible to shareholders and trustees is accountable to the investors. I think here there is a need for some discussion. I hope the AMC's chiefs will sort of talk about it. The other question is there a need for a sponsor. Sponsor today does not have the role, at least in the mature mutual funds, that it used to have. So there can be some distancing between the sponsor and the AMC becomes quite an independently well-governed structure with all the governance, best practices of governance, including, running the business and looking after investment interest is not a conflict. And I think that is something that, one should be going towards. The second issue which I thought for discussion, a number of initiatives have been taken place recently in terms of disclosures, in terms of riskometer, in terms of how the performance should be reported to the investors, in terms of the timeliness of reporting. But is the investor really aware of all these things? I think there's a lot to be done by AMFI as to tell the investor what is it that the regulators have done, what is it that the investor ought to be getting from the AMC, and to what extent all this is being complied with. I tried to, with my small little investment, try to see whether whether I had been informed of my details of the performance and then versus benchmark, and whether I had been given the details. And I found in some cases it had just not come. So issuing circulars is one thing, but seeing that these get implemented and complied with, I think is really very important. The third point, I think the enforcement. There is a need for looking at this whole thing. No doubt a principle-based regulation is a very, it really enables application of mind for individual cases. And there's always been this discussion between principle versus rule-based, and even if you have a principle-based regulation, you have to finally back it up with rules, especially when there are other people who will interpret those rules and regulations. So I think the philosophy of investor interest, if that is paramount, and anything that is detrimental to the investor's interest would be, not exactly legal. And whatever the rule, the letter may say, one would have to go to the spirit. I think those kind of things will have to come into this whole regulatory structure. That should be 4. There is a need for, because there have been some, probably regulatory arbitrage between ULIP schemes and mutual fund schemes. This is an old thing. Today, I think, that issue is no longer there, but still the problem continues with the kind of upfront commission, large commissions, and the whole selling is based on the commission approach. So there is a need for looking at this whole uniformity in the approach. I come back to the point of promoting the passive funds and the ETFs, which can be done at much lower cost. And there is a need. There has been studies on cost in the Indian industry, and it is something as an average. We are not at the high end, we are not at the best end, but there is a constant drive towards moving towards a lower cost. And this is, could, like I said, be done by really promoting the sale of funds which are really, typically tied to benchmarks or ETFs. Finally, I wanted to raise the issue of data privacy and cybersecurity. This is extremely important. A lot of personal data is held by the AMCs, the mutual funds. And I think this issue is becoming extremely important with more and more digitization. And I think we would do well as an industry to look at these things. Well, with that, I stop my presentation. I have just raised a couple of issues for all of you to discuss. Thank you.
Thank you. Thank you, Usha. Mutual fund sahi hai. Yeah. So, very good evening, good afternoon, good morning, depending on from which part of the world you are joining in. Welcome to the first panel. We have 12 representatives from mutual fund in the form of CEO and CIO, representing over 80% of the industry. So everything you want to ask, you want to know but afraid to ask, I think you'll get all your answers. When stock market at a peak, obviously the second part will talk about buy, sell or hold. But before that, first one is we are actually asking the CEOs whether they are relevant, who needs mutual funds. Who are they? I'm going alphabetically. A, Bala Subramaniam. Now, if you want to know who is this Bala Subramaniam, gentlemen, you don't know, is Bala from Birla. Kalpen Parekh, DSPM Mutual Fund. Then we have Navneet Munad, HDFC Mutual Fund. We have Nilesh Shah, Kotak. We have Radhika Gupte, Edelweiss. And finally, Vinay from SBI Mutual Fund. 6 of them. We'll have a few rounds and then few questions. So first question is essentially, first round is preliminary remarks from each of you, gentlemen, and the lady, and we'll go alphabetically. We'll starting with Bala. Essentially, who needs mutual fund? The provocation is the direct access. I'm just getting some numbers. In January 2020, the Demat accounts were 39.5 million, and in March it was 40.8 million, and as we speak in October it's 73.8 million. So from January it's gone up by 87%, and March it has gone up by 81%. Direct entry into mutual fund, and parallelly, how does the mutual fund portfolio gone up in terms of people investing in mutual fund? From 89.7 million in March 2020 to about 107 million. So less than 25%, less than 20%. And how was the mutual fund AUM has gone up during this time? I don't have the March number, October number. These are all September number. AUM has gone up from 22.26 trillion to 36.74 trillion, about 65%. So the rush of people, particularly during the COVID time, to invest directly, it has democratized the entire, the investment process. But the question is, do you find them as challengers, the Zerodhas of the world, or how do you, like the bankers say that collaboration is the way with fintech. Insurance funds also say the same thing, collaboration and coexistence. How do the traditional mutual funds, in fact, one insurance guy got very upset with me when I said traditional. They said, we are not dinosaurs, we don't talk about this thing and all. So I'm afraid what adjective I should use. I don't know, it's up to you. How do you defend your top going forward? So we'll start with Bala. You're on mute, Bala.
Yeah.
Yes.
Thanks, Amal, for this kind introduction. I think mutual fund has gone through the journey of more than 25 years with the entry of private sector mutual fund, and it's come a long way. And if you ask me, the mutual fund serves whom? It serves a common man. Every person in the country who has a savings has to look at mutual fund as a vehicle for his savings. There is no question about that. So definitely, I think what has happened in the last few years, the awareness about mutual funds have gone up quite significantly. And because of the mutual fund awareness going up, and because the size of the industry going up, as Madam Ushathura has presented, 15% of the GDP is a representation of the mutual fund industry size today. And we were just about 11%. Such a large representation of the GDP coming to the mutual fund has created actually the larger counterforce, one, in development of the capital market in India. And today, whatever we feel proud about Indian capital market, especially in equity, the mutual fund has played a very big role in channelizing public savings, in putting that money into use in the Indian equity capital market. The same way Madam mentioned about the debt capital market got significantly better. Again, thanks to the Indian mutual fund industry, who are built alongside of the equity as a vehicle. Fixed income also is a vehicle they have built, and therefore, again, mutual fund are playing a bigger role in developing the debt capital market as well. There used to be a time where all of us used to wonder and worry about FIs have got a dominance market share in India, and they remain a very strong force in India. When they come in, it comes with big force. When they move out, they go with the big force. Fortunately, Indian mutual fund industry have become one of the largest counter force for foreign inflow of foreign investors' money into India. And today, nobody even talks about so much of foreign outflow comes and so on and so forth. That's something, again, have been created in the mutual fund, in addition to in serving the large pool of growing needs of the savers in India. Therefore, mutual fund can definitely play a bigger role. Though there is no doubt in the last 1 year during the pandemic period, everyone had in the country had enough time on the earth, and they could actually spend most of their time in terms of uplifting the learning curve, understanding more about stock market investing. Unfortunately, we have seen only the one-sided market the last 1.5 years. If somebody comes to a conclusion that 1.5 years of up in the market is considered as a permanent move in the capital market, then they are actually they're mistaken. Given the fact that the mutual fund is one industry, have gone through various cycles, ups and downs of many kind, and there are many situations that you have faced have completely shaken the confidence of investors in India and globally. And despite all those ups and downs, after seeing all the ups and downs, mutual fund industry has grown to where they are today, only because of the improvement of transparency, high governance, efficient way of managing money, giving one of the best possible experience for the investors as one of the best investment alternative vehicles. Therefore, I would probably begin by saying that mutual fund is actually serves the need of every saver in the country. I would even call it as the mutual fund vehicle is one of the most trusted, reliable investment vehicle for the middle class population in the country. I'll stop here, Tamal, and we'll have discussions as we move forward.
Thanks, Bala. Very, very, very strong defense put up by Bala. So what he's saying, it's probably a temporary phenomenon. Let's hear Kalpen Parekh from DSP. Kalpen, over to you.
Thanks, Kamal. Bala was my boss for a few years, so he's anyway said all that was important. Yet, let me try to add my perspective. You are also, in a way, asking a barber that who needs a haircut. And he'll obviously say everyone who has hair. And even those who don't have, we can do some bit of, polishing. I believe firmly in that. I have, I started my career not in the fund industry, but have been a mutual fund investor for 23 years across debt funds, equity funds, hybrid funds, and international funds. And I want to just extend what Bala mentioned, that mutual fund is nothing but a vehicle. It's a pipeline to give access to anyone who has money, whether he is a rich man, whether it is a corporation, whether it is a bank treasury, whether it is a retail investor or a middle class or even a lower middle class investor. Anyone who has money and time horizon, mutual fund is the right vehicle for that. And let me also highlight that today, through a diversity of categories which are available, mutual fund allows investors to participate in owning businesses. So, whether it is equity funds which allow you to own businesses, whether it is commodity funds which allow you to own diverse commodities like gold or energy or metals, whether it is international funds where a lot of innovative business models of the world which are disrupting also can be owned, apart from traditional equities and bonds. So a lot of diversity of product range is available for investors. And I'll recount a personal example. My driver has been working with me for 15 years now. Today, his daughter is, is about to get enrolled in aeronautics engineering, and a lot of her education has been funded by an SIP which he had started around 12 years back. Out of his salary, 2,000 rupees went into an SIP. And so I'm just trying to say that a 2,000 rupee investor also can benefit from a mutual fund. And today, the largest investor in the fund industry is one of the largest treasury of the country with around 60,000 crores of assets. So that's the range that mutual funds can really, play to. And to an investor who believes in, running a marathon and playing a test match, this is a beautiful product. No doubt, last 1 year's run rate of account opening has been more in favor of broking industry, which is also great. We need to learn from them how they have simplified their interfaces and become more accessible to young investors. But that also is opening up the enabler for growth of passive ETFs, because as more broking accounts open, these same investors tomorrow will be able to invest in ETFs, which need a broking account. So, till 2 years back, the dilemma was that mutual fund investors in total were 2 crores and broking accounts in total were less than that, roughly around 1 crore. Then how would ETFs grow? So today, with broking accounts, opening up at a faster pace, over time, if mutual funds deliver the value that they have delivered so far in the last 25 years, I think the runway is very long. At 2% penetration, like what Madam highlighted, it is a long runway, and I'm very confident that we will fulfill diverse objectives of diverse set of investors. Thank you.
Thanks. Let's shift to Navneet. Your preliminary comments.
Sure. So completely agree with what Bala and Kalpen mentioned, not because they are my ex-colleagues, but otherwise I'm a strong believer in mutual funds. Anybody who's a saver and needs to invest that money, whether to park for an emergency need and want to earn some returns which are linked with money market, or for income generation through fixed income instruments, or for long-term wealth creation, need something like a mutual fund, which are highly regulated, extremely transparent, intensely scrutinized by media, people like you and public at large, professionally managed, and some of the other things that Bala and Kalpen have already mentioned, and also are needed, as Usha rightly mentioned, that equally needed by the other side, who are the people who need those savings, be it the government of India or the corporate sectors or the household sector, which borrows money from the financial sector, who in turn gets the risk capital from us, whether in the form of debt capital or the equity capital. So we perform a highly important role in the economy and have a long way to go. I think Kalpen has rightly mentioned about the significant interest in the capital markets, while large number of demat accounts have got opened. But I think it's a challenge while an opportunity as well for the mutual fund industry. I think we can learn a lot from some of these trends over a period of time if we continue to remain focused on investor education, continue to give the message that for long-term wealth creation, it's all about sound investment plus time plus patience with discipline, and not about trading on a daily basis. I think that's the way to create wealth, and we have the right vehicle for that. I think continue to focus on the more innovative, I would say, marketing strategy to ensure that we provide the same user experience, the same user interface that they get on the on let's say a broking app. I think I'm sure mutual funds have a long way to go. As Kalpen and you also mentioned those numbers, the demat accounts have gone from roughly 4 crores in March 20 to a little over 7 crores today. 3 crore new demat accounts have got opened, and in the same period 60 lakh odd unique investors have got added into the mutual fund industry. But one heartening feature is that in the last quarter alone, 30 lakh new folios got added. So large number of new investors are getting added into the mutual fund industry over the last few months. As the interest in capital market remains high, I'm sure more and more investors would find value in a product like mutual fund. And just to give another perspective and the number who needs mutual fund, the largest asset manager in the world is BlackRock, which manages close to $10 trillion. The largest bank in the world is not even half of their size. Now, Mr. Vinay is here. The largest asset manager in India manages little over 6 lakh crore, while the largest bank in India is 6 or 7 times of that. So you know where this industry is heading over the next several decades.
Thanks, Navneet. Nilesh, over to you. But before that, just one interesting thing is that I think in sometime in December 2020, SEBI allowed that even the fintech can have their own mutual fund, provided, of course, it doubled the net worth requirement, capital requirement to 100 crore. And some of the fintechs have already started applying for and setting up their own mutual fund. So that adds to the, it becomes more interesting that when I am a broking house and continuously getting millions of people I'm serving, then why do I need a mutual fund, the traditional one like yours? So, yeah, Nilesh, over to you.
So, Tamalda, many thanks for inviting me over here. I completely agree what my colleagues, peers, Bala, Navneet, and Kalpen have mentioned. Whenever I'm confused about what am I doing in mutual fund industry, I just walk down my office, and quite regularly I meet people, especially from northern India. They are from impoverished background, and they are there to fill up application form for recovery of their dues in a collective investment scheme called PACL, the Nirmal Singh Bango Company. Whenever I see them, I get the purpose of my life. I have managed money for treasury. I have managed money for family offices. I have managed money for HNIs. I have managed money for urban India. But I have to reach out to that last man sitting in Bharat who have been cheated by collective investment scheme. They need my expertise. They need my service. I have to make money for them. I have to convert their savings into wealth creation. There is a nice poem which has guided me in my life by Makran Dave, a Gujarati poet. Gamtu mariye to gunje na bhariye, gamta no kariye gulal. When you get something, you don't pocket it, you share it with others. The Indian mutual fund industry has some incredible talent in terms of picking up investments. We have made mistakes, no doubt about it, but we haven't repeated those mistakes. And it is our job to share that talent in serving our investors, in making them wealthy. In some sense, we have to become the stress busters of our investors. Today, financial worries really hurt everyone. We need to be their stress busters. Give us your financial worries, we will manage it and give you your financial freedom. That is what mutual fund is supposed to do. That is what we are supposed to do. And regarding your question on fintech, more the merrier. Collectively, 44 mutual funds have serviced just about 3 crore Indians. There are 30 crore more Indians which we have to reach out. We are today urban-centric or probably top 30 cities-centric. We have to reach out to every pin code of India. And that is possible with expansion of this industry. If we have to reach those heights which Navneet mentioned, this will be not effort of just one person or one firm. It will require many more efforts, many more hands, and more the merrier with fintechs joining. Their digital technology will help us expand our distribution network, our investor reach to a many-fold. And that way we will be able to grow and serve our customers.
Thanks, Nilesh. Over to you, Radhika.
Thanks, Tamal, for having us. And I won't repeat any of the points my colleagues made, but I'll make a few short points. Firstly, I joined the mutual fund industry about 4 or 5 years ago, significantly after many others. But the first product that I invested in when I moved back to India about 10 years ago was a mutual fund. And it's been the only financial product that I've invested in. I haven't done direct stocks since then. And outside of being in the mutual fund industry, as a consumer, when you realize, for all the reasons that my colleagues mentioned, how well regulated, transparent, varied, and cost effective this product is, it made a lot of sense to enter the industry. And I think the fact that today we are going to go from a mutual fund industry of 40-45 players to 60-65 players, if some of the biggest names in fintechs and other big business houses of India are choosing to enter the mutual fund industry, I think that says volumes about our potential. Second comment, I want to address the issue that you talked about in terms of direct equity versus mutual funds. Now, Nilesh alluded to North India. I am sitting in a house in North India with about 5 other family members. And I have to say there's one individual in my house, is my brother. He's not a mutual fund believer. He does direct stock picking himself. And he was having a conversation with everyone else in the house saying कि ये सब आप लोग mutual fund क्यों करते हो, ये करने की ज़रूरत क्या है, you can go directly to these companies, etc., etc. But in the same house, I have a 32-year-old woman who's my bhabhi, who doesn't want to, do stock picking all day because she has a job. I have a mother who's a school principal, and I have a retired father and a maid in the house. For these 4 people out of 5 in a household, mutual fund serves their need of being able to invest in a trusted product with all different investment needs. I mean, you have the most aggressive to the most conservative in this single household. And the point I'm making is, while there will be a buyer for direct investing, this story will repeat in every household. The great thing about India is you have people who cook at home, you have people who order on Zomato, there's a market for vada pav, there's a market for fine dining. And I think in that sense, we solve a mass consumer's problem. And the last point I'll make is, I don't make too much of, a lot of accounts opening. I think the game is not in opening many accounts. I think the mutual fund industry or any industry's success is in keeping people through cycles. Bala mentioned that we've just started a cycle. I think if the mutual fund industry can get people in the right products at the right time and keep them through a cycle, that's the battle we have to win, not fighting over how many accounts anyone has opened.
Thanks, Radhika. So your family is a microcosm of India in some sense. That's what you're saying. Brother is going for direct investment, but the rest everybody made father, bhavi, everybody is through mutual funds.
4 out of 5 is through mutual funds.
Yeah. Okay. Let's hear the CEO of India's biggest mutual fund. I think about 6 trillion. That's your AUM. What's the latest, Vinay?
634.
Yeah, so 6.3 trillion, biggest mutual fund. Over to you, Vinay.
Thank you, Dharmendra. At the outset, you have been putting up a great show the last 10 days, and thanks for getting all of us on. After my friends and stalwarts have spoken, hardly anything for me to add, but then let me give my own perspective. This question, which if we go back, who needs mutual funds? It's a very interesting question, and I look at it from 2 ways actually. 2 different perspectives here. One is like looking at, when I have the equity markets which are giving me such good returns, why do I need mutual funds? Point number 1. Second perspective is, what type of people need mutual funds at all? So let me look at a response for the first perspective. See, it's all very well when the markets are going up in a very secular way, as the markets are going up now. Bulls are on a rampage. Correction has been expected for the last 1.5 years, but life is quite fine. Now this gives, I would love this to continue. God forbid that there should be any major correction. But the confidence that we get by winning in good stocks sometimes could get misplaced. And this, what I call as the Vedas touch fallacy, that whatever I touch will turn into gold. This could tempt us into investing in not so good stocks also. This is something which I think we must look at avoiding. all of us on the panel have seen enough cycles to know better than thinking that the bulls will continue to be on the rampage. Now, the second part, which has been addressed, I think, by my stalwarts also, my friends here, who needs to? Now, let me reverse this and say, who doesn't need mutual funds? I think everyone, if you look at the range, if I look at it as from an expertise angle, I think right from the novice to an evolved investor would do well to invest in mutual funds, at least to some extent for the evolved investors. Ticket size wise, the small to large, geography wise, I think Nilesh was already talking about that Bharat, that penetration which we need to do. Metro, we have urban and then semi-urban and then rural, everyone who doesn't need. And what are the needs for? You call it wealth creation, you call it for different investment needs and solutions. And now here I would like to distinguish between, see, we are basically a nation of savers. Now, are we also equally a nation of, I think this is the conversion we need to help out, making this nation of savers into investors. The industry is doing a wonderful job on this. And another angle which I would also need to look at is the financialization that is happening, which was also covered to some extent in Madam Usha Thorat's slides also. This is another angle which we need. A lot of disposable income today. I think we would do well to put them in mutual funds. We have enough number of solutions, and this transparency also that has come up. And to close my bit, I would suggest to Radhika's brother that he can sleep well. Let him start investing in mutual funds.
Okay, good. Thanks, Vinay. I think we didn't expect anything else from six of you. Was a spirited defense. I mean, that's what you were expected to do. And even though the trends are different, Bala was more like a bit of a nostalgia trip, no offense intended, public sector bankers, we build bridges, we build infrastructure, and now you say we're not doing anything. So that's what sort of a bit of tinge of nostalgia. But then Vinay was talking about, I think, one day T20 versus taste and everything. Nilesh is stress buster. Radhika's entire family barring one. Navneet wants to climb new peaks. All good, great. So let's get into the second part, and we'll start with the lady Radhika, and then we'll go randomly. So tell us that, well, if you say that, well, this is a temporary phenomenon and mutual fund is more secured, and I started saying that this is a democratization, you said no, mutual fund route is more democratic. How much money you have doesn't really matter. Everything else you said in favor of your, but just tell us, how do you attract millennials? Because they are the people, they work on their mobile, and they do everything. They are impatient, and they have also intelligence much more than an old man like me. They know, they keep a close tab, what's the market happening and all. So how do you keep them engaged, and how do you get them under your fold? Radhika, your dad will be there, but how do you actually, I don't know, if you have a younger brother or your children, how do you keep them engaged? Usha made one very interesting point that we don't complicate things, maybe make it much more simpler. I don't know, education to you keep on saying. So in this round, can you give us some suggestions? Let's not repeat. So one person will say something, then others you say newer things. So what's the way to actually, if it's not a temporary phase, and if we believe the market commentators, this will continue for the next few years. This is the India story people are talking about because of our reforms, because of a lot of things are happening in India, and also the external, what's happening in China, we are getting a benefit out of that. So everything else, it seems like in our favor and in favor of the market. How do you actually broad base? How do you attract more people, particularly the millennials? I think that our median age is 27 in India. Radhika, over to you. Start with you.
Tamal, I'm assuming I've been asked this question first because I'm the youngest on the panel. I must tell you, I'm also a borderline millennial. So, I'm answering this question although I'm well past the 27 mark. So I think there are three parts to this. And I think, peers of mine have made comments that there's a lot to learn from everybody, including the broking industry and, dare I say, cryptocurrency, about the interest that they've got from millennials. Millennials are a real audience base. I think there are three things. One is having the product available digitally, which I think the mutual fund industry has solved, I think, across fintech platforms, across our own platforms, and now even from a servicing point of view with things like MF Central, sales and service digitally is one, and I think that is basic hygiene. The second is, I think, building products that are interesting for millennials. The millennial consumer is a very, very savvy consumer. I'll talk about friends of mine and siblings of mine. They want products that they can touch and feel. And I think one of the things that I have seen is there is a lot of openness to new ideas. In 2016 and 17, when we were selling international funds, Tamal, I don't think anyone was interested. You used to hear this thing, India ka market itna acha kar raha hai, kya kar rahe ho? One of our most popular funds has been a US technology fund and a China fund. People hear about disruptive technology companies. They know a Tesla or an Apple or a Facebook or, even some of the other, Match.com. I mean, these are companies that people touch and feel. So I think openness to new products that speak to the millennial consumer without making them, so complicated that they're bad for the consumer, I think that is important. And that is something that, we are looking to do. And I really think in the last 1.5 years, openness to new ideas has definitely gone up. And I think the third thing is engaging with millennials in a new way of communication. And I think the post-COVID world has also given us many more communication formats. I mean, I've been locked down for 18 months, but between mediums like Clubhouse, Spaces, using influencers, social media, and a lot of D2C consumer brands are getting this right. You are having conversations with millennials. So I think also reaching out and having those conversations on new mediums, I think these are three things. I would just end by saying, though, that again, the objective is millennials are an impatient bunch. And, being a young person myself, I say this, the objective is also to get them into the right products and make sure they don't just come for this cycle and stay across the cycle.
Navneet?
So every generation has been smarter than the previous ones. And I think the millennials and Gen Z, so I have a millennial daughter and a Gen Z son. And I think that they are a lot more smarter, a lot more, I would say, aware. And then they look at the world differently. I think our generation look at the world differently than the previous generation. And I think Radhika touched upon very right points. I think you need to speak in their language. You need to speak on their mediums. You need to speak at the level at which they understand. And a lot has been made, and I think it's a very complicated question. We try to kind of put every millennial in like one single basket. I mean, a millennial in a town in Bihar is far different than a millennial maybe in the place in let's say Mumbai, and you have to think about this entire generation differently. But at the same time, one of the things that I keep thinking that we believe they are very impatient, they love this trading, I mean, when it comes to investing. At the same time, I keep thinking this is a generation which is thinking a lot more longer term than the previous generation, right? They are the ones who are a lot more worried about the future of the planet, the future of the society. They are a strong believer in the triple bottom line than maybe the previous generation. So I think we have to, as she rightly mentioned, even that side of the coin, where what their money is doing to the world as much as what their money is earning is equally important for them. And I think you have to hit those right notes when you are putting the right offerings in front of them.
Okay, Navneet, just your little secret, like Radhika's brother, your children, do they invest directly?
No, yeah, I just wish at some point in time when we look at the saver population of India, it looks like Radhika's family where 80% of the people are investing in mutual funds. So in her family, 80% of people are investing in mutual funds. As of now, it's just 2.5–3% investing in mutual fund when it comes to the country as a whole. Over a period of time, it changes. One of the important aspects, the fundamental tenets of investing don't change. While millennials today, because maybe they get hugely influenced by the social media and looking at some of the maybe the high-tech companies in the West and might invest in international funds. But I think that the long-term wealth creation happens again, repeating the same STP, sound investment plus time plus patience. And I think the intense focus on investor education is very, very critical. And that's what I think our industry has been doing over the last several years. And I think we need to continue that focus with a slightly different medium and and the different communication channels, which I think Radhika rightly talked about.
Thanks. Bala, I am keeping you as a last speaker because you started it. So in this round, you will go last. Let's ask Vinay. Say State Bank of India, you are a banker for every Indian. 1 out of 3 Indians bank with you. So when it comes to mutual fund, how do you attract the millennials? You are on mute, Vinay.
Yeah. See now, yes, in fact, similarly, we have this dream of being fund manager to every Indian out here at the mutual funds. So now, a couple of things when it comes to millennials. One is we need to educate them intensely with how to keep them away from dangers. Today, if you see what has been happening in the last 5-6 months, or maybe even a year after the COVID boredom had started, actually, fixed deposits have become boring, routine investments have become boring, and the millennials want newer and newer things. In fact, yesterday I was surprised to know that there's something called as an NFT, non-fungible token, of a Bored Ape, which went for $2.7 million. Is someone buying it for? I do not think it is just for the heck of it. They feel that it's a good investment. So that is the point we have reached. I think we need to educate them about the dangers. And then point number 2, Navneet was putting it very right. We need to tell them about, see, luckily they have started early. The power of compounding kicks in when someone starts early. And this is known as the 8th wonder of the world. I think this is something we must educate them that please stay long. They want to retire at 40 or 45 today. I am looking at how do I retire at 60 or 65. And now maybe the next generation, I have my own nephews and nieces who want to retire at 40. They say, uncle, I want to chill out. I want a hut in, wherever, exotic locales. So fine, all that is fine. But we also need to invest our time and money into something very safe. And this is what, I do not know what happens to the NFTs. No disrespect to any of this. But then what happens to this after? I know, at least in the mutual fund, I know what is my growth, how am I growing? My fund managers are there to take care. They tell me transparently what is happening. Maybe I don't get a fantastic return of 100% every year, but then fair enough. It's growing well, growing very patiently with the time. I think this is what we need to educate to the millennials and bring them into the safer folds of investment.
Thanks, Vinay. Nilesh, you said that whenever you get an opportunity, you start traveling and see India, the ground reality. So tell me, how do you attract the millennials?
So I must admit that I am a failure in connecting with millennials. Both my daughters believe that I am not doing anything worthwhile, and hence they have not decided to join my profession. On a serious note, when I ask my daughter that why don't you want to become a finance professional, she asked me what value add you do to the society. Today's millennial is different. If we have to connect with them, like Radhika and Navneet and Vinay mentioned, we'll have to be a little bit different. We'll have to be like Tulsi Gowda, who planted 30,000 trees. Or we have to be like Hare Kalla Hajabba, who, despite being a fruit vendor, built a school for education and positively impacted society. Our investments will have to make money for millennial undoubtedly, but they'll have to add to the environment positively. They'll have to impact society positively. If we can be a true leader in impacting society and environment positively and establishing standards of governance, I'm sure we will be able to attract all millennials to mutual funds.
Okay, so it's in a completely different perspective. And finally, over to you, Bala sir. Yeah, you are on mute.
Yeah. Thanks, Amal. As Nilesh mentioned, I also have both my daughter and the son that do not want to pursue the profession of financial world. And not that they don't like this business. Definitely, they don't like the way we work 24/7 and all time you only busy with your work and work. They don't want to get into that kind of a game, and they also want to have fun along the way and also build the society, which could have probably a larger benefit from them, not by just managing the money. But having said that, clearly, from the millennials' point of view, I think most of the millennials have to, of course, understand, or maybe we have to educate them the purpose we are trying to solve. Actually, I think mutual fund provides a solution for every purpose that one has in life, whether it is millennials or the middle-aged person or the old-age person. There is a purpose which every individual has got. Second is millennials have got huge aspirations. How those aspirations can be fulfilled by way of investing in mutual funds through the intuitive feeling. I think most of the people want to have fun while making investment, whereas investment is in general is considered a very serious business. I think if you're able to convert that serious business with some kind of fun combined with some kind of purpose it can serve, and definitely the millennials can be attracted to the mutual fund. At the end of the day, millennials know very clearly that the aspirations have to be met at hook or crook. I think that's something they're extremely clear about what they want to achieve. And those achievement fulfillment can be driven through the mutual fund, which of course is quite possible. That's why I call it the purpose. That's something you're able to communicate in a very simple manner. The power of compounding, what Tonsi spoke about, which is eighth of it, the power of the world. That's something you spoke about. The power of compounding is something nobody can ignore, and that's something we're able to clearly mention it in a very simple languages. That's something can attract a huge pool of millennials to be a mutual fund investors.
Thanks, Bala. We are getting many questions. We'll take them later, but let's quickly have Navneet, you wanted to add something? Yeah, please.
I mean, as some of the other people mentioned, and I've heard this from millennials, that investing is another form of entertainment. I mean, as Bala mentioned, it's a serious business. But you may find some of these youngsters where there are a couple of apps. So let's say something like a Fortnite, something like a Fantasy 11, something like, let's say, where they are investing in a crypto or an NFT, what Mr. Vinay talked about, and maybe a stockbroking app. And they find it really tough to differentiate one from the other, because everything is like a form of entertainment, but investing is very different than let's say having entertainment with some of the other things that you do in life. And I think that's where the intense focus on investor education in the ways or on the mediums that Radhika talked about, I think is the need of the hour.
Thanks, David. I think Amphi has been doing it continuously.
Absolutely.
You know, the mutual fund Sahi Hai is a kind of,
absolutely.
You know, the moment you put on TV, any channel, and we see all the be it cricketer or you name it. So let's quickly get into some of the interesting part is, of course, lots of things we'll discuss in the next channel, next discussion where the fund managers will talk. But here we ask you, Radhika raised this, and I'll start with again, Radhika. Quickly tell us, it's the international versus domestic. Where are we? You know, of course, retail can take the LRS route versus AMC, where we have to go through it. So I would ask each of you to give a couple of minutes, not more than that, please. One is the two trends. One is international versus domestic, and active versus passive. I remember, Navneet, your fund, HDFC MF, created sort of noise by filing 9 passive funds at one go with SEBI. So first, Radhika, Navneet, you will come at the end, and in between all of you, international versus domestic and active versus passive. What are the trends?
I don't think anything is versus. I think on international versus domestic, international is a must-have, but it is not the first fund for any investor, including a millennial investor. I think if you have to understand equity risk, you should understand it in your home market. But after you have experienced equity in India, definitely I think international investing adds a lot of value. And here I think, and by the way, even my brother who doesn't do mutual funds otherwise, does international through mutual funds, because mutual funds genuinely make it a lot more convenient versus the LRS route. The costs of just trading stocks, doing currency conversion and opening a brokerage account, let alone doing stock picking abroad, versus picking from Indian mutual funds where you have exposure to everything from US technology to China to disruptive healthcare to REITs. I mean, the range that we offer at a 5,000 rupees starting size is fantastic. So if people invest for the right reasons in international funds and at the right stage, it's fantastic. And we've seen this trend personally explode since 2017. On active versus passive, I think if I were the CEO of Maruti and I sold both Alto and Ciaz, no one would ask me Alto versus Ciaz. So I'm always amused at why, as a mutual fund CEO, I have to get asked this question. I don't think the debate in India is active versus passive. It is about, as ma'am said, getting more people into capital markets and getting more people into MF. There is a market for people. I consume a lot of pizza, Tamal, and it's my favorite food. And there are times when I go to fine dining Italian restaurants because I want the customized chef experience and I know he'll give me a fantastic meal. And there are times when I'm traveling in China and I want the standardization of a Pizza Hut or a Pizza Express. And both work for me. So I think the industry should focus on building good products in active and passive and educating consumers the right way. And I say this with zero bias because Edelweiss MF is 50 active, 50 passive.
Mm-hmm. Okay, let's see. How often you go to China?
I have taken three. Well, I haven't done it before COVID. I did 3 trips because it was my father's favorite.
Okay, Kalpin.
I think both
international versus domestic, international versus domestic, and active versus passive.
Again, both, Tamal, because when and can solve most of your problems, why limit yourself with or? And one very important dimension I want every investor to learn about is when you blend international and India together, the long-term returns remain intact, but the volatility comes down. So there is very little focus that that has been given to these hybrid concepts, which is a combination of Indian and international funds or Indian and international stocks together in the same portfolio. So my school of thought is what is equity investing all about? It is buying the best businesses of the world, right? Whether in India or outside. So ultimately, it's the same asset class. It is no different, just that the flag of the country is different. But from an investor point of view, you're buying the same return on equity and the growth rate that companies offer you. And who is to say that only India has the best rates? There are companies outside also who have grown at faster rates. And you look at the last 20 years, first decade, India beat the lights out of developed markets and US. Indian markets, emerging markets gave the best of returns. And the whole narrative was that India will probably become the fastest growing country and one of the largest market cap countries in the world. In the next decade, which is 2011 to 20, US markets delivered 12% return and in rupee terms, and Indian markets were, let's say, 7 or 8% return. So when investors try to choose either or, it only harms your long-term compounding and it increases the volatility in your portfolio. Now, today, for example, since 2020 and 21, because international stocks have done well, people have started investing in international stocks more often. And in the last 1 year, Indian markets have outperformed by 24% versus the global markets. So these cycles will keep changing. Investors should buy the best companies of India and the world in hybrid portfolios. So I would go with that. In terms of active and passive, while passive is a very large trend which is emerging, but remember one thing, thanks to great efforts by SEBI also in terms of bringing cost efficiency, a lot of direct plans today are available at cost structures closer to passive funds. So you're getting active management at the cost structure of passive funds. So rather than being dogmatic about these labels, investors should go one level deeper. That what are you aiming for? Passive makes sense if you do not have confidence on your fund manager, and if the fund manager doesn't have ability to generate alpha. But if, like Nilesh mentioned, there are so many managers who over 20 years have generated alpha, and they are available to you at 70 to 90 basis point cost, all in, best stocks of the world, best stocks of India. I would go with a good blend, but my bias today is still more active in my portfolio. My personal portfolio is 80 in favor of active and 20 in favor of passive.
Thanks. Nilesh has given your name, so it's your turn now. Tell us, also give the percentage term, both international and domestic and active versus passive from your offerings. And yeah, go ahead.
So, Kamal, we are here to serve our investors and partners. Whatever they need, we have to produce. Local, global, active, passive, they all serve the purpose of investors. If you are looking to invest globally, your objective is to get diversification away from India concentration. It is to invest in businesses which are available cheaper outside or which aren't available in India. And maybe if you have desire to send your kids abroad for study, you need to invest in offshore funds so that you create dollar asset to take care of your dollar liability. In active funds, you will invest only if fund manager is adding value to you. And I just want to give one episode where you'll have to evaluate a fund manager on a longer term basis. In 2017, a mid-cap IT company entered into a mid-cap index. It entered at 1% and by end of 2017 became 4% of index. Every single mutual fund manager decided to stay away from that company. Out of 44 asset management companies, none of us invested a single naya paisa in that company. Throughout 2017, we were underperforming benchmark indices. Today, that stock is down 90% from its top, and we have been vindicated. But if you had evaluated whole of 2017, you would have said that we are underperforming index. At the end of the day, as CEO of Kotak Mutual Fund, my job is to serve my investors and my partners. I will create the product. I will define the risk return parameters of the product. I'll manage it to the best of my ability. I'll educate my investors correctly and hope that they consult mutual fund distributors or advisor and select the right portfolio for them. At some point of time, we will also see development of wrappers in India, where we will provide tailor-made solution to a conservative investor, to an aggressive investor, and so on and so forth. So either you'll have a ready-made allocation available from mutual fund through asset allocator wrapper product, or you will choose the services of mutual fund distributor and registered investment advisor to create a tailor-made portfolio. Your portfolio will be complete with local and global, active and passive, depending upon your need.
Want to say anything from your offerings? What's the percentage? Like Radhika said, 50-50. Kalpen said 80-20. Anything you want to, unless it's classified? Yeah, quickly.
So, no, it's completely open and transparent. There's no classified information in mutual fund. In terms of local versus global, we will be probably 2-3% in offshore assets and 97% local. In terms of active versus passive, we'll be probably about 5% in passive and 95% in active. As an individual investor, I have put 100% of my money in active funds. I trust my fund managers.
Thanks, Nilesh. Bala, over to you.
Yeah, I think the way I see Tamal is, while there is a good discussion happening around international investing, I would assume first and foremost, all Indian investors have to invest in Indian equity first. I believe that we are still not scratched the surface against the potential of the opportunity that exists. And the underserved people in India, especially for investing in capital market, is so high. Definitely, I think they need to first get their first experience by investing in Indian equity. Therefore, I would assume the international equity versus domestic equity comes only for those people who are fully exposed to investing in India and have large exposure in equity. Therefore, they're looking for some diversifications of investing in overseas market for various purposes, which in relation others spoke about. So that's something I believe that first and foremost, wet your feet by investing in Indian equity, gain an experience, then start looking at diversifying your assets beyond the border. With respect to active versus passive, definitely I think if India has to become very large size in economy, and which essentially means that the GDP versus market cap, if you have to see, the market cap also has to rise along with the GDP growth. Therefore, India is going to provide a great opportunity to find many companies which are not part of index, which can provide huge value accretions to the investors. Therefore, active managers will get enough opportunity to manage money more actively in order to generate not just alpha, the absolute return, which are of course much higher than what otherwise a common man will get by investing in any other instrument that's available in the market. As Kalpen mentioned about the cost structure in the active managed funds have come down quite significantly, not just only a direct plan. Even the regular plan, as the size of the funds become larger and larger, there is a gliding path already been defined in terms of expense coming down. So I think India is the only country where there is a narrowing of expenses as the fund size becoming bigger versus an ETF, which nowhere in the world exists. Therefore, there is hardly any difference between the active funds and the passive funds. I would assume, I think large pool of investments will have to go to the active. But having said that, the passive, of course, is more of a lazy investing. If somebody wants to invest and then leave it at that, probably they can choose that. When it comes to the question of my personal investment, I have 100% of my money is in equity. 100% of the money is invested in my own fund, which is Aditya Birla Sun Life Mutual Fund. And in the color ETF, I have still not been chasing passive funds, as I feel the cost difference is not going to make me more richer, and therefore I continue to keep my investment only in the active fund.
Thanks, Bala, and congratulations that you recently crossed the 3 trillion mark, right? Your AUM.
Yeah.
Congratulations. So over to you, Vinay. Last word is yours on this subject. Vinay, you have to unmute yourself. Yep.
Mother, thank you very much. Very interesting question on the, like domestic versus international. Kalpan has spoken my thoughts, but I'll just add that if we can give our investors an opportunity to invest into some of the happening names today, like what we know as the FANG stocks or the Netflix or the Alphabets, why not? It's not that we advise anyone to get fully into this international stocks. There are two critical concepts which we look at while investing. One is the asset allocation and the diversification. Both these get addressed to some extent when we invest across the borders, provided the investor has a very, very clear understanding that he is exposing himself to two risks here. When we invest only in the Indian markets, it's just the market risk, the equity market risk. But when we invest abroad, we are exposing ourselves also to the currency risk. As long as I have this understanding, I'm very happy when our investors get a chance to go abroad. As of now, for us, it's baby steps. Some of our funds have a small component which gets invested abroad. We also have a new fund offering which gets invested into the US. But apart from that, we are yet to go fully into this international funds. It's baby steps, but it's doing very well. There is a lot of investor interest. Now, moving on to the active versus passive, I'm very fine with the global trend of passives coming into India also. It's come in a very, very strong fashion. And many people tell me from across the globe that that is the way to go forward. I don't completely believe so. We must be in active equities also. But there is one thought, small discomfort which I have when we look at too much of funds getting into the indices here. Funneling is happening into very few stocks. We say that the stock markets are a mirror of the economy. I'm very fine with that. But I would like the broad basing to happen as far as stocks are concerned. So for example, now, instead of a Nifty 50, maybe if we could have the underlying as a broader index of 200 or 500, as happens in some countries, I would be very happy. Yes, mirror of the Indian economy is fine, but I only want the silver behind the mirror to be a little more clearer and stronger. This is what I would say.
Thanks, Vinay. Navneet, apology to you. I said last word is Vinay's, but I forgot that I started with you talking about your record and making a lot of noise, 9 passive filing with SEBI recently. So yeah, please.
So on the international versus domestic, I mean, you have a very provocative title of this talk, who needs mutual funds? And I think we've been saying that every saver in the country needs mutual funds for maybe parking a short-term cash or income generation or wealth creation. And as investors have evolved, as markets have evolved, as the ecosystem and infrastructure has evolved, we have also evolved. So historically, I mean, diversification meant diversification across asset classes, diversification across style or market cap. But now investors are looking at diversification beyond domestic markets. And let's say we had this developed world fund of fund where in one single fund you could get country diversification, style diversification, sector diversification, currency diversification, you know, which I mean, as the saying goes, diversification is the only free lunch available in investments. And I think investors are looking at that, and we are providing a solution to that. On your another point of filing 9 single ETFs or the index funds on one single day. So while we have been one of the oldest players when it comes to the active management, we have also been one of the older players when it comes to the passive management. So we are one of the oldest index fund in the country, way back in 2003 when passive funds were, I mean, very, very small. SDFC AMC launched one of the first passive funds, and they have got an 18-year track record. So, I mean, as Radhika and Kalpen and everybody else mentioned, in India, we haven't reached the stage where we should be debating active versus passive. It is about active and passive. And as Kalpen mentioned earlier, that if there are 7 crore demat holders, a lot of those investors would look at ETFs as one of the vehicles to invest into the markets, and we need to have the products for them. There are a lot of other investors who are looking at passive products, but we strongly believe in active. In fact, my belief has got reinforced after seeing in last 1 year the kind of alpha that has got generated by our funds and several other funds in the industry. I mean, we have one of the longest track record. We just celebrated our FlexiCap NAV crossing 1,000 rupees. The money has got multiplied 100 times over the last 25 years. And if you put in terms of alpha, that's 6% per annum over a 25-year period. So while having a track record of active and believing in active, but we also believe that passive also has a long way to go if we want this industry to grow from 2.5 crores to maybe 10 crores and 20 crore investors.
In percentage term, your size would be about 4.5 trillion, right? You are the third biggest, SBI MF, and then ICICI, IPRU MF, then yours. So what is active versus passive and overseas versus domestic in percentage term you want?
No, it's very small. I mean, almost most large part of the assets are in active. The passive as well as the international are very small, but over a period of time they are likely to grow. We always want to be a one-stop solution, and Nilesh also alluded to it, that industry has been moving from being pure a product manufacturer to a more solution provider, and it's important for all the for players like us to have all products which are needed by the investors, where we think that we can build a capability and there is a sustainability and longevity in those products.
I wish we could carry on for some more time, but we have one more session. So some of the stuff which will spill over there, but let's at least take a few questions. This is a question from, let me pick this first question from one gentleman called Mr. KK Mittal. He talks about, he's referring to Mark Mobius's recent comment. He says that India is on a 50-year rally. Do the panelists agree? Who wants to take it? Bala, Navneet, Nilesh, India on a Kalpen raises hand. Yeah, India on a 50-year rally.
See, yes. Someone even commented on Mark Mobius's comment that it should have been better had he said 100-year rally, because there is no one else to validate in 100 years what you say. So, jitna lamba aap track record future mein forecast karoge, so there is no one to validate. But again, my view is these are headline grabbing comments. We cannot forecast our future 1 year later, 5 years later, or 10 years later. So I don't come from a camp of making long-term projections like this. I come from a camp that, be disciplined, diversify your portfolio across asset classes and countries, and give it time. Every country will work in different cycles and different phases, and stick to your asset allocation. Don't get carried away with these type of forecasts. These headlines typically come at market tops. I'm not saying this is a market top, but that's my comment.
Thanks. Anybody wants to add anything?
If we said that on a country, as a country 50-year rally, I would agree that maybe a century. So till 200 years back, for hundreds of years, we were the world leader in economic terms, as a civilization, as a culture. We are the ones who have taught the world many things. And maybe last 200 years were more of an aberration, where the center of gravity shifted first to Europe and then to the US. Maybe I think this part of the Pacific is regaining its glory. So I would agree, but markets will have their up and down cycles. There will be several cycles in next 50 or 100 years, but as an economy from $2,000 to 5, 10, 20, 50, I'm sure we have a long way to go.
Okay. Let me ask this, Bala, you wanted to say, but let me ask you a separate question. It is M. Vasanta Krishna asking, is taxing of dividend in the hands of investors turned away any mutual fund customers? Is it a dampener for mutual fund?
Yeah, it's not a dampener for mutual fund. At the end of the day, these are the regulatory changes from a taxation angle, which has, of course, been streamlined to ensure there's a smooth flow of a taxation model, and which used to, of course, be happening at the scheme level. Now, of course, it's happening at the investors level. So that way it brings in, addresses the concern which otherwise used to be addressed, or rather questioned earlier by the investor. Therefore, is something I would say it is done in the best interest of streamlining the whole process. I think
Okay.
the first question, I just want to just add to that first question of Mark Mobius.
Please.
A person who is a genius, a legend in the investment world, most recognized person, having seen cycles, do not want to make a comment on the market in the short term. Of course, the very fact that he is talking about 50-year market means anybody who try to predict the market in the short term will be a futile exercise. So the genius talking about 50 years, it means that he's looking at every investors have to look at the longer time horizon for the investment. The longer time horizon, the definitely of the fulfillment of market expectations far, far higher, which otherwise will not happen in the long term. Otherwise, you could easily say next 3 years I see a bull market, and it will sustain and so on and so forth. The very fact that they're talking about 50 years, the long run, every market is a bull market. I think that's the assumption investors have to come.
Yeah, thanks. We are running absolutely out of time. But last question, anybody wants to, maybe Radhika, you can quickly in less than a minute. It talks about the green investment. How are the funds concerned about climate changes and all? That's it. Yeah, Radhika, quickly.
I think the short answer, and Nilesh and Navneet said this, is we will have to become more ESG conscious. It's not just climate change, it's companies that are positively impacting society. It's companies that are handling diversity better, companies that are handling governance better. So I think we have no choice. Our investors, globally investors are already demanding this from asset managers. So when we run global mandates, we are already very tied to doing this. And I think increasingly consumers will demand this. So this is a choice. We don't have a choice but to move in this direction.
Thanks, Radhika. I wish we could gone on for some more time, but unfortunately we are completely running out of time. So what's the key takeaway? It's only expected 6 CEOs of India's large funds, and you have to defend your term tough. Interesting part is this: in order to defend your tough and trying to tell us how you are evolving, attracting millennials and all. A lot of you talk about your brothers and sisters and dad and driver and so on and so forth. So it's pretty interesting. It reminds of the 1980s film Bunyad. You don't know which part of India you are in, but you feel very integrated with your family. So your parents would be in some other parts, you are in some other parts, brother is some other part, but you're watching Bunyad at 9:30 and you feel very happy about it. It looks like mutual fund also tying up the family in the same way, that bonding. So great to hear that. So mutual fund is here to stay. That's what Usha ma'am is kind enough. She's listening. She has all along been here.
Sorry for this. There was another one which was called Hum Log. So we are like Hum Log. We are all collaborator, not a competitor, to ensure that Fruits of Growth reaches 1 billion people.
Absolutely.
Okay, Navneet. So let's end with that. Call it Hum Log or mutual fund sahi hai. So that's it from my side. We'll take a very short break. Thanks Bala, Radhika, Navneet, Kalpen, Nilesh and Vinay for an interesting and engaging discussion. I'm sure the audience also enjoyed. At least the stream of questions, flood of questions tells us that story. See you again next year probably. And we'll take a quick break. Over to you, Manish.
Thank you, Tamal. What a discussion indeed. Reminds me, I need to top up my mutual fund investments. Thank you, Usha ma'am. Thank you to all our panelists. And yes, we'll take a very short break and get back with CIOs commenting on buy, sell or hold. Stay tuned.
Thank you.
She has ambitions of becoming a brand. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है टू रीच योर गोल्स।
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making his investments talk. Business Standard.
यार एक बात बता, मार्केट्स ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है to reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
He's making plans for an early retirement. Business Standard.
यार एक बात बता, मार्केट ट्रिकी हो तो इन्वेस्ट कैसे करें?
मार्केट में अपॉर्चुनिटीज तो बहुत हैं, बैलेंस और फ्लेक्सिबिलिटी जरूरी है to reach your goals.
ऐसे ही म्यूचुअल फंड्स आपके गोल्स को अचीव करने के लिए बहुत ऑप्शंस देता है। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
She has ambitions of
We are
becoming
back with the CIO, and we are back with the CIOs panel. Over to you, Tamal.
Thanks, Manish. So, welcome back to the second show of CIOs markets, buy, sell, or hold. Everybody wants to know. So, we'll start straight away at the current market level. I mean, there have been ups and downs, but the graph is secular. It's been rising. Tell us if I'm an investor, should I invest or pull out of equities and stay in cash and wait for opportunities? Because one school of thought is market is getting overheated, economic fundamentals do not justify what we are seeing in equities. On the debt, there are issues of interest rate would go up sooner than later. US taper already is starting in November. UK is holding on. Reserve Bank of India, we need to see. In some form, I would say tightening had started. Reverse repo window is no more the benchmark rate. It's the reverse repo auction window, which is the benchmark rate, which is higher than the reverse repo rate. So slowly tightening, even though the governor said that we'll wait, we will continue to have accommodative monetary policy till the growth is secured. But it seems like that, yes, the petrol price cut, excise duty cut will give some relief, a few basis point relief on the inflation front. But we will see inflation, we will see interest rate rising over the next few months. So that's the debt and equity. It's little overheated. That's the perception. In the first round, we'll ask you, all of you, to give your preliminary thoughts. We'll go by alphabetically, Lakshmi. Before that, you can tell us and our readers that I'm sure you must have seen both Rajnikant and Akshay Kumar. To liven it up, which one you like? You start with that, and then tell us. It's not debt versus equity, okay? But of the two Diwali offerings, if you have seen both, which one you like, and then you talk about it.
Hi, Kamal, and good evening, everyone. I was in Mumbai, so I have seen Suryavanshi, and obviously my vote right now goes out for Akshay Kumar and his clan for bringing the much-awaited movie buffs back to the big screen. And it was a fantastic experience. Contrary to my own thoughts, that if OTT is in, probably a movie buff like me would not really visit theaters. But of course, the drive-in was an experience of its own. So yes, that is as far as the Bollywood movie verdict is concerned. But anyway, I wanted to actually start off with a dialogue on, from the Suryavanshi, the movie Suryavanshi. For those of you who have seen, Akshay Kumar actually made a statement or makes a dialogue in that Mumbai Police passport ke religion dekh ke goli nahi chalati, criminal record dekh ke thokti hai. And why I start off with this is because I think that's also true for central bankers. कि central bankers market के sentiment को देख के react नहीं करती, वो inflation को देख के करती है. So I think right now there is this huge dichotomy between what the markets are thinking, and pretty much it's across the world. It's not just in India that bond markets are running way ahead of what the central bankers are thinking. So last week, when India was in Diwali or a holiday mode, we actually saw two central bankers have pretty dovish outcomes. One in their FOMC meeting, which is the US Fed, where they're not in a big rush to hike rates, number one. And number two is they've still downplayed the inflation story. And second is Bank of England, where contrary to bulk of them, concluding that there is going to be a rate hike, there was no rate hike. So I think back to fixed income, there is reality that central bankers world over have realized that excess created must normalize. The wheel has begun to spin, and easy money and low rates can no more twin. So gradual unwind is the way, but I would say earning fixed income carry is what the bond markets have to say.
Okay, Manish, over to you. Buy, sell, or hold?
So first of all, on movies, I think it's a global world. So I prefer to go for No Time to Die because I'm a James Bond fan. And I just got put off by the reviews of Suryavanshi. so I just, I love the Bond movie actually. And in a sense, I think just to follow up Lakshmi's cue, No Time to Die is the correct phrase for equities because see, you can be very bearish, right? Optically, PE is very high. Behaviorally, retail investors are hurting. Credit spreads globally and domestic are low, which is on a contra basis, you should be negative on equities. But I just think that the amount of negative real rates we are seeing globally, and if you see the US bond market, the funny part is not the negative real rate. The funny part is that your 5-10-year inflation expectations are still above 2%, maybe 2.3, 2.5%. And still people are buying bonds at 1.5%, right? Now, this can only mean two things. One, that the bond market is expecting a big recession coming forward, going ahead, that is. Which, to my mind, when the whole world has been through COVID and a lot of regions have to open up, a lot of economic activity within India, for example, schools, malls have still not opened up fully. To be negative on growth, which would also reflect in inflation expectations. So no one's negative on growth. So the other explanation, which is I think a bit scary for value investors, is that these real rates are going to stay longer than we all thought. And if that is true, there's no time to die for equities, right? Because you can't afford not to be in equities because you will get top line growth by inflation due to operating and financial leverage. You will get good earnings growth. So one traditional metric is basically your nominal GDP minus your 10-year yield. If you see over next, leave the base of FY22 because you're coming out of COVID, but I would expect that in India, given the high inflation relatively, and the fact that you're coming out of not only a 1-year bad cycle, you're coming out of 7-8 year bad cycle from a capex perspective, etc. Then over next 2-3 years, nominal GDP minus 10-year bond should be 7-8%, which is obviously a big spread. Then how do you not be in equities?
Okay. Naren, you represent India's second largest mutual fund by AUM, 4.6 trillion. Is that or more than that, Naren? I see.
The number luckily keeps going up, so that is a positive.
Yeah. So yeah. Right now it's 4.6 trillion, right? Or more than
yes.
That. Yeah. So tell us, second largest after State Bank of India. So what's your take, buy, sell, or hold?
I think luckily the entire lever is now not with movies or something like that. It is with the central banks. And the central banks, the global central bank, in many interviews, I've called it a global central bank bull market. because the global central banks are, people like you interview people like us, but we don't hold the key. The key is held by the global central banks, who actually have $25,000 billion of money they have pumped into the market. What we have is 460,000 crores, which is nothing compared to $25,000 billion of money that they have pumped in. So I think the key is going to depend on what they want to do. For every inflation number, if they decide that it is transitory, then we are going to have a big bull market, like what Manish says, nominal GDP is going to be very good. Which asset class can you be in other than equities? Because if nominal GDP will keep going up as inflation keeps going up, and in an atmosphere where inflation is higher, equities is a much better asset class. Having said that, I don't think there are problems of note locally. I think if I look at where the corporate sector is today, they have deleveraged. If you look at the government sector, the fiscal deficit numbers this year are very good. In 2017, 18, 19, we used to fear the NBFC sector and weaker banks and lot of real estate sectors. We don't have any such problems. So I would say that locally, the economy is in good shape and there are very few problems to worry about locally. But we certainly fear that global central banks have pumped too much money, and that has caused investor exuberance across the world, and that risk exists. So I would say that economy is fine, everything is fine, but there is investor exuberance due to global central banks, which can cause a correction. So it doesn't change the structural narrative, but cyclically there are risks due to this. That's how we look at it.
Thanks, Naren. Interesting that you are one of those who, who believe that it's the central banks which actually fueling the rally. Call it ultra loose monetary policy, call it not printing by central banks, depending on the context. But that's what is at the root of stock market going high and high and high. So let's hear Nilesh Surana, Mirai Asset. Yeah, Nilesh.
Yeah, hi. Yeah. So let me take the easier part on the movie thing. So I, like Manish also, I've seen No Time to Die. Get to watch Suryavanshi. And on your specific answer on between buy, sell and hold, I would remain in the buy camp. Just put in I would say buy within well-defined asset allocation. I mean, the view is constructive on equity, and it's primarily coming from the fact that earnings outlook has improved, in fact, improved significantly. Cost of capital is low, and valuation near term may be sort of reasonable or maybe above normal, but in the longer term is still sort of fairly okay. And I think that this time the equity markets have acted as a classic leading indicator in terms of partly discounting the long pending cyclical recovery in the economy, and also factoring the lot of structural longer term changes which are taking place. So why I'm saying cyclical, because we entered the pandemic when the going was bad. FY20 was low GDP growth year. PAT to GDP was only 1.9% to GDP despite tax cuts. And a lot of sectors were to mean revert. Pandemic wave 1 and 2 sort of only delayed that. But as we look that because of lower interest rates, because of tailwinds in some of these sectors like IT, metals, housing, because of consolidation, because of formalization of the economy, net, we are seeing a massive recovery in earnings. So from first normalized year, let's say FY23 on the base of pre-pandemic FY20, earnings will increase by 90-95%, almost 24% CAGR. So in that context, and of course, the longer term story is very solid. A lot of reforms have taken place last 4-5 years, but we are yet to see series of years which could benefit from that sort of reform. So we have taken the pain and the gain is yet to come. So net, I would say that despite near-term slightly elevated valuation, the view is buy, constructive. Just a couple of points from an investor perspective, I would say one should come with a longer-term time frame, and let's say 3-5 years, and one should come with slightly more graded sort of expectation of, let's say 10-12% sort of returns. If that be the expectations, I don't think the markets would sort of disappoint.
Thanks, Nilesh. We'll get into the micro details subsequently. Let's hear, Prashant Jain, HDFC.
Good evening, everyone. And I haven't seen any of these movies, so let me past that, I think as far as bonds are concerned, I think clearly the focus of central banks has probably shifted towards maintaining growth more than targeting inflation. And I mean, I do agree that these loose or easy money conditions are one of the key reasons why asset prices have done so well over time, over the last few years. I think inflation is a key going forward, how much it persists at what levels, but we don't have the answers today. But one thing which we need to watch out for is if and when India is included in the global bond indices, because that could have significant impact on the interest rates here. Coming to equities, while, I mean, I think I would agree largely with what Nilesh said, and I think valuations are fair. They could be slightly expensive if you think near term. I think bulk of the money over next few years should be made by earnings growth and very little from PE multiples moving up. Inflation is a pass-through for equities. Equities are a hedge against inflation. And to that extent, equity investor has to worry less compared to the bond investors in this environment. I think investors should clearly have more moderate return expectations, and time horizons need to be longer. I think 3 to 5 years is the right time frame, and nothing less than that. So I think while you said answer in buy, sell or hold, I don't think a simple answer like that is possible because whether you buy, sell or hold depends on what is your time horizon, what is your risk appetite, and how is your current portfolio where compared to where it should be. But let me just add one last point. In the last 42 odd years of Sensex history, 100 Sensex has become 60,000. And many a times, multiples have been where they are today. And if you invested around those levels, yes, for some time, returns were not there or less, or maybe even markets corrected. But the beauty of equities is, especially in a growing country like India, that the impact of growth on returns far outweighs the impact of multiples moving up or moving down. So I would say those with long-term investment horizons, more moderate return expectations, I would say equities should continue to outperform bonds as they have done for a very, very long time.
Thanks, Prashant. The last speaker on this round. Over to you, Rajiv. Rajiv from Parag Parikh. Rajiv Thakkar. Yeah.
Thank you, Tamal, for the opportunity. So with your permission, I'll take this in two parts. The first part is I'll complain about the question itself. So it's a occupational hazard that people like us have to answer this question: buy, sell or hold. So an insurance company will keep getting premiums from a person for 20, 30, 40 years. Pension fund manager or the provident fund manager, people will keep having their provident fund deducted and they will keep investing for, again, 40 years from the age 20 to 60. Whereas in mutual fund, because the product is an open-ended structure, people think that they need to do something very frequently, or they need to time the market in terms of tactically shuffling between cash, bonds and equities or other asset classes like gold. Irrespective of what I'm going to say next, my recommendation to people watching this is that if you are like me, where retirement age is more than 10 years away, and if you are having long-term goals, just stick to your asset allocation. No need to do anything. Let your SIP get deducted every month and stick to your allocation between equity, fixed income and emergency funds and your risk covers. So that's the first part. For the second part, I'll let out a secret from my student days that in an exam where there was a descriptive answer to be given, and if I did not know the answer to the question, I would write whatever I knew, even though it's not related to the question which is being asked. So and I'm not as good as macro as the other people on the panel. I don't know what the central bank balance sheets across the world are, or I've not seen all the 3 movies, so I'll straight away get to what I actually know. In equities, I think there are pockets where serious amount of money is going to be lost. And especially in the frothy space where companies are coming out for listings where to justify the offer price, one has to go 3 decades out, 4 decades out. And I think some serious amount of money is going to be lost in that space. At the same time, there are pockets in the market which can be safely held, and there are pockets in the marketplace where one can buy. If we just rewind back to the past markets where valuations were at elevated levels, let's say late 1990s, where there was this whole split between the old economy and the new economy. When there was a bubble in the new economy shares, the old economy shares were available at very, very reasonable prices. Let's go to 2007, where there was a bubble in the real estate, infrastructure, and commodity related stocks. Again, some of the quality companies were available at very, very reasonable valuations. And if one invested on 31st December 2007 in some of those companies and held for 3 years, one was reasonably safe despite all the global financial crisis and things like that. 2017, the frenzy was in small and mid caps. And if one stayed away from the most frothiest stocks, I think people came out of it reasonably comfortably. In the current marketplace, I think if any of your stocks are trading at very, very large market caps, where some of the companies which have been formed in last 3, 4, 5 years are suddenly becoming Nifty 50 companies, and where either earnings are completely absent for the next 5 years or the earnings multiples are 300, 400, stay away from those kind of places, and broadly people should be fine. Even on the bond side, everyone knows that the short-term interest rates will go up, liquidity will come out, but I think there is some element of steepness to the yield curve already. So the overnight rate could go up from, let's say, 3.3 330 to 4%, and you could still have the long-term rates not moving up so sharply. Mr. Prashantjan already alluded to the fact that we could be in the bond indices, so that could also cushion the rate increases. So broadly, I think investors should be fine as long as they are not into the too much of the bubbly space.
Yeah, thanks, Rajiv. So I would say broadly, there's a note of caution. That's it, not beyond that. All of you think that, yes, market is broadly fairly valued, and there's still some upsides, but don't be impatient and don't be greedy. And of course, inflation can play the spoil sport as far as debt portfolio is concerned. We need to wait. So we'll get into some of the things that you, each of you in your own way mentioned. But before that, I just want to ask you, everybody wants to know, because last year or year before at any mutual fund conference, we used to talk about what happened in Templeton, what happened in ILFS, what happened in Yes Bank, the 81 bond where investor lost money. So tell us, each of you, probably we'll start with Naren and just random will go. Is this was behind us? Because that was the time when in our business standard conference, I think Naren were there, Lakshmi was there, Prashant was there, at least 3 of you there, distinctly I remember. You were on a defensive mode. You used to say that, look, mutual fund do make mistakes, and this is one of the times, but we will get back. There is resilience in the system, etc. Now, as we speak in November, post-Diwali, November 2021, all these shadows of Templeton, ILFS, 81 bond, Yes Bank, is it now gone away? Everything is behind us? Naren?
Clearly, I mean, one thing I must say that thanks to the good processes and credit that we had, in that cycle, we had no problems. So it was very good that we did not have problems in that cycle. And right now, credit issues are clearly not something that the system itself has at this point of time. And SEBI has also taken a lot of steps to actually ensure that each of us have a lot of guilt in each of the portfolios, and various steps have been taken by the regulator as well. So I would say the system has become very safe relative to what it was. But if you look at it from a different angle, does the country require only AAA and AA debt to be issued? In our opinion, frankly, for the growth of the country, you require all kinds of debt to be issued. We are having, as Rajiv mentioned, you have a number of IPOs which are happening where earnings will come in 2027 maybe or 2029. So you're having retail investors investing in those kind of IPOs. So the problem, what worries me is that you are saying that single A debt is risky, but IPOs where 2027 and 29 IPOs are being hotly invested by a lot of investors at this point of time. And that kind of worries me at this point of time. So I would say that yes, the risks in the credit market are completely behind us, but there is just too much exuberance into companies in the new age space in the equity side. So I would say that the risks are on the equity side today, and we worry always because when we are managing other people's money, we always have to worry. And that is part of our DNA. And people sometimes write to us saying, why do you worry? But the reality is we are paid to worry because we are managing other people's money. If we were managing our money, we can just go on. So in 2017, 18, 19, when we avoided some of the 81s and did not take the credits, people said, why are you cautious in credit? Now today people ask us, why do you talk about the risks in IPO market? But the reality is the risks are today in the equity IPO markets, not in the credit markets.
Very valid point, Naren. We will of course go deep into those. We will refrain from naming any companies. That's what we have decided. But the trend, yeah. Over to you, Prashant. This shadow of ILFS, Yes Bank, everything is behind you.
So clearly, Tamal, I mean, see, these were issues that were important at that point of time, and I think the industry and the markets have moved beyond that. And I think, as Naren pointed out, most mutual funds, including ours, I don't think were impacted by this. And I think clearly, I mean, we have come a long way from there. So I really don't have much to add. And as Naren said, I mean, and as others have also pointed out, credit spreads are actually quite low and credit markets are in good shape. There is ample liquidity, weak demand for borrowings. And I mean, I would agree broadly with Naren, not entirely, that yes, there are pockets of exuberance in equities, but I don't think we should say that's true for the whole equity markets. I mean, you can't focus on 5% or 10% of the market cap being in a expensive space and say that the whole markets are expensive. I think earlier a point was made, there are pockets of value, there are pockets of reasonable valuations, and there are also pockets of exuberance. And I think that is up to each one of the investors, mutual fund managers to decide what they make of these different pockets. So overall, I think I am constructive on the economy. I am constructive on the profit growth cycle. The profit growth outlook is never been so good. In fact, it is surprising that in the COVID year, the profit growth has surprised all of us. And you look at sector after sector, the profit growth has been extremely robust. And I think looking at the current low cost of capital and the growth outlook of economy and profits, I would feel quite okay if you have a proper time frame. Yes.
Rajiv, over to you.
I think I'll expand on what Naren said. Essentially, the problems of debt market have been put behind us by moving to sovereigns and AAA or at best AA. Essentially, the lower rated market in the debt space for the mutual fund is just not there. And the problem that we face in India is that we don't have a buyer in the stressed asset space. So if we look at something like what is happening in China with the real estate companies in trouble and a company like Evergrande having its bonds falling, defaulting and bonds falling in price, you have someone like a Goldman Sachs stepping in and trying to buy distressed paper at low rates and aiming for making some money over there. in India, what happens is if a company defaults or there's a risk of a severe downgrade, the paper simply becomes unsaleable. And because of that, what is happening is at one end, you have corporates which are borrowing at near sovereign rates or at rates at which state governments borrow. And at the other end, they are not getting any money whatsoever from the debt market, and they are forced to go to banks and borrow at whatever rates banks are lending to them. So I don't see a problem on account of the debt market, but longer term, if we want to fund the small and medium enterprises and some of the lower rated players and allow them to grow, we need to find some solutions for corporate credit events where either there's a default or there's a rating downgrade. I don't think we have a solution yet for that problem.
Yes, we don't have any. I mean, we don't have any junk bond market. I mean, that's a structural issue. Yeah. Nilesh, you want to add anything? And after that, the rest of you, Lakshmi will come at the end. Yeah.
Absolutely not much to add beyond what Prashant, Naren, and Rajiv mentioned on the ILFS part or IT1 sort of part. I think we should look at both numerator and denominator. On the pool of the credit, I think we've come a long way. So that's not I mean, that's far behind. And on the second sort of point of discussion, which the previous panelist mentioned, is I think I would agree again, there are certain pockets of fraud, but not at an aggregate level, any sort of bubble zone. I mean, there could be fraud in maybe consumer chemicals, new age, some of these businesses. But at an aggregate level, particularly looking at the pool of the profits of the overall companies, I think there are many sectors which are reasonably sort of reasonable sort of valuation and long-term structural growth potential still intact.
Yeah. Yes, Manish?
The way I would think about it is basically, I think an economy can face challenges from two directions. One is domestic balance sheets and two is external accounts. And my sense is 2013 to 20, we cleaned up the domestic balance sheets. So if you see household and private sector balance sheets are largely cleaned up. Government balance sheet obviously has suffered, but in the global context, I think India's government balance sheet is not too bad. And on a growth perspective, to my mind, you couldn't be having a better outlook than this for the domestic economy because very simply put, GDP has four parts: private consumption, private investment, exports, and government spending. All four, to my mind, over the next 2-3 years will fire, maybe first time after 2003. So there is a possibility of getting a very good domestic cycle. My hunch is the problem will come from external accounts. So if you see India 2011 to 13 developed an external account problem where CAD reached 5 to 6% of GDP.
Yes.
Then we had 2013 to 20, we had a lot of domestic problems. Typically what happens is if you have a long cycle of problems like we had on the domestic side from 2013 to 20, those will never be the future problems, right? I mean, because you spent 7 years, 8 years cleaning them out. And this time, unlike 2013, I think it will not be India's fault in the sense that 2011 to 13, you could have blamed India that we probably overconsumed and that's why our CAD reached 5 to 6% because the fiscal stimulus after the GFC was too much, never withdrawn in time. Unfortunately, I think this time, we will face a problem because if Bitcoin is 66,000, who's to say oil should not be 120 or 140, right? I mean, there is the downside of liquidity can manifest in things which India doesn't produce, which is oil, energy in general. So in terms of probability, my point is that I would bet that nothing on the domestic balance sheet will give you a crisis. But I think the biggest chance of equities facing a big downside is a commodity super cycle. That too not led by demand like we saw in 2000 because of China's growth, but just because of asset inflation.
Okay, new challenges, that's what Manish is talking about. The debt-related issues are behind us, but there are new challenges. Quickly, Lakshmi, your take, and then we'll get into the most interesting part which I feel everybody wants to know. I'll come to that. Yeah, Lakshmi.
So clearly, paranoia has given way to a lot of comfort. That's reflected in the fact that the AUMs in the credit category also has been growing. And I think there is a lot of, given the fact that capital gains from fixed income is not going to be a primary driver for returns, probably in the recent past or maybe going forward. Accrual assets have started finding a fancy in investors' portfolio, and with the right reasons, of course, as well articulated by all the co-panelists right now. And I always believe that with every multi-starter, there is always room for I would say small beginnings. So you started off on a Bollywood note, Tamal, by talking about the Rajni movie, the Akshay movie, which were all big screen movies. But none of us about this OTT release, on Netflix, which was Meenakshi Sundareshwar, which was Bhagyashree's son's debut, Abhimanyu Dasani. I'm not giving a review about the movie, but what I'm trying to say is that with every large cap AAA kind of corporate, there is a case for these existence in the portfolio. Of course, given the time and given the cycle, there is absolute greed and absolute fear. We are at the stage right now where credit spreads have significantly compressed. So it's not a roaring, screeching, screaming buy. But yes, there is that small element of spread which still exists, which can well be capitalized upon.
Thanks, Lakshmi. Now I just want to touch and feel each of you, the big elephant in the room, and tell us what's happening. Naren, you were the first to point out, and then I think all of you did point out in your own ways. It's the value versus growth. What's happening in the IPO market? If you typically you talk about price to earnings, now price to trailing earnings, 1,000 times happening. If you see the market cap at one particular IPO, which is if the gray market valuation, if I look at it, and if I calculate the market cap, price to trailing earning will be some 1,000 times, and that's for a profit making company. And there are companies which are in losses and going and very high premium. You look at the gray market, and one way of making money past 1 year people say that you just have your money and put it in IPO. That's all. You see the IPO financing price is going up. Home loan is at historic low, 6.4, 6.5, 6.6. But you see IPO financing is going up, the pricing. And then RBI also tightened how much NBFC can support in terms of financing and all. So this, I'm not getting into names because we are not discussing any particular stock. We are not giving any recommendation what to buy and what to sell. But can you tell us, this value versus growth, what's happening? And what is your advice to the investors in the IPO market? We'll start with anybody, maybe Rajiv.
Sure. So we all have seen the US markets where some of the innovator companies of the 90s have given stupendous returns to the investors. And in the early days, they were not making too much profits, or they were not, or they were probably in losses and were in losses for many years. Still, investors have done well by investing in those. So let's say Amazon from the 90s, if one had bought Amazon on listing, one would be sitting on hefty gains today. And people extrapolate that for the Indian IPOs, where, okay, the total addressable market, or TAM as the acronym goes, is very, very large. Operating leverage is large. These companies are right now having large fixed costs, but when you divide that over lot of customers, profits will be huge. Or currently they are paying a lot of money to acquire customers that will taper off down the road. That's the promise that, or that is the story that is portrayed in the promotional materials. And this will be true for one or two companies down the road. I don't know which ones. But on an average, every company may not turn out to be an Amazon. That's the fear that I have for the people rushing in to buy some of these IPOs. So you should have the end game in mind. Firstly, the unit economics should be positive. So if one unit of good or one unit of service you are providing to the customer, the selling price should be more than your variable cost on that sale. If that is not the case, then it's very difficult to say that as volume grows, the company will become profitable. So that is number one. You can justify a larger fixed cost, but you cannot justify subsidizing the customer at every unit sale. And you should have some clear idea as to by when the profits will come and whether the market cap that is being asked for in relation to that eventual profitability is reasonable or not. I would urge some of the investors to look at some of the listed companies, which are so-called old economy companies, but which are doing precisely the same thing that some of the IPOs are doing in a different pocket of their area of operations. So you could have a food delivery company coming out with the IPO. At the same time, you could have an existing listed company, which has an app which gives you food delivery at home. Or you could have a fintech company offering payments, and you could have some of the existing listed players already offering some of those facilities. So don't just look at the newer companies, also look at some of the listed companies is what I would urge.
Yeah. So every company can't be an Amazon. Anybody wants to take it from him? Anybody, please carry on. Naren, you want to add? Yeah, Naren.
See, basically the point is that, having seen IPO cycles for a long period of time, IPOs, the seller is always well informed. And whenever we have seen big IPO cycles, whether it is in 94, 95 or 1999 or 2007, we've seen that these cycles, at the end of the cycle, you do see overvaluation. And it is a buyer beware situation. I mean, I do agree with most of the other participants that the overall market is not bizarrely overvalued at this point of time compared. But I believe that it is the duty of every investor to think carefully in IPOs, because if you look at, I used to be in IPO investment banking between 1990 and 94. And in the 31 years that I've seen IPOs, I believe that if investors had missed one or two IPOs, it's okay. But by and large, IPOs did not deliver returns for investors. And the number of companies which disappeared after doing IPOs, particularly in the 90s, was amazing, actually. Of course, regulation is improved, SEBI has come in, various things have happened. But I believe that the kind of valuations which we see in IPOs is totally unrelated to the IPO valuation in the secondary market at this point of time. And the amazing thing, for the last 5 years, we used to tell people, whenever market starts coming with IPOs which are based on top line, worry. And this is something we used to tell all the way from 2013 onwards. And exactly now we are that situation where there are so many IPOs which are coming based on top line. And the investment bankers who are selling them are very smart investors. And even the sellers are very smart. So I believe that, it is the duty, and, what we learned from the credit funds is that after the losses are made, people are asking questions, but the investors knew that credit funds carried risks. Like that today, I believe that the investors who are investing in IPOs, investors who are investing in equity should know that there are these risks. And this is the learning that I have from looking at all the credit funds, although we were very cautious and investors didn't lose money at all. But I would, in our funds, but I would say that investors have to practice asset allocation and prevent risk. And the overall markets are not as risky as the investments in IPOs. This is what I feel at this point of time.
Yeah. Anybody wants to, Nilesh, want to add quickly?
No, very quickly on the value versus growth template.
Yes,
I mean,
yes.
I would over time sort of learn the hard way and would go with what Charlie Munger mentions, that growth has to be subset of value. See, traditional value, cigar butt of Phil Fisher or Benjamin Graham times doesn't work in India because it's a growing market, or anywhere for that matter. Similarly, on the other side, overpaying for growth also is not advisable. The point is, this discussion is coming because of a lot of new age IPOs. But as you see in our portfolios, most mutual fund portfolios, all these businesses are hardly 2-3% or even less than that. So the larger part of the market is still, there are pockets which are growth-oriented businesses which are available at reasonable value. And so I think, the debate is while and the media attention is on new age businesses, but that doesn't represent the market on aggregate.
Lakshmi, want to add something?
value in fixed income depending on what kind of category and which segment you are holding. So there is never a debate, at least on the bond markets, with respect to value or growth. Yes, there are, as I said, categories within fixed income which definitely offer value, like this in this current phase between say AAA bonds versus state development loans. We believe state loans are the underdogs, where they are very, very under-owned, both from FPI and from Indian investor perspective. Spreads have compressed. So those kind of opportunities will keep arising, and one needs to keep an eye on these kind of opportunities.
Yeah, Manish, and lastly, Prashant. Manish?
My point is things are more complex than what we make out to be. So one part of this whole challenge, and I don't think we should disregard the internet platforms, in the sense that obviously 9 out of 10 or 8 out of 10 are over expensive. But the thing is, if you go back and see how industries have evolved, it is a lot to do with management, right? I mean, if you bought Google in its IPO, would you have modeled that they will buy YouTube? If you bought Amazon in early 2000s, would you have modeled that they will build Amazon Web Services? If you bought BlackRock in mid-90s, and BlackRock was probably started 40 years after US asset management industry started, would you have been able to imagine that it will become the biggest asset manager and whose market cap is probably 5 times the next guy? So the challenge, I think, is not to go by easy or very top-down analysis. The thing is, the payoff of picking that 1 or 2 or 3 managements out of 10 is so huge that I would not brush everything off. I think if we keep our heads down and do hard work, we will get maybe the next Google, the next Amazon, the next BlackRock. So,
so it's the management that's what is.
I think it's all about management.
Correct. Yeah, Prashant, over to you.
Tamal, to be honest, I don't have much to add beyond what has already been said. I just feel that, these are cycles of the market, and I think Parag referred to earlier, whether it was 92, 2000, 2008, 2016, 17, we have seen pockets of excesses and pockets of deep value or good value, and things tend to change over time. So there is nothing new or out of place in what is happening in the market this time around. Only the sectors which are expensive or cheap, they keep on changing places. And I would also partly agree with what Nilesh said, that these pockets of perceived excesses are very small part of the market. And finally, I think there is merit in what Manish also said, that some things may appear expensive when you think near term, but it's a changing world. If someone executes better, there could still be value over time. So I would say there is not much to worry about. It's a free market, and everyone in their own wisdom will construct portfolios. But what is happening, I think, is perfectly normal markets operating. Yes.
Thanks, Prashant. Hold on. We just have a quick take from each of you. People want to know, if I'm an investor, where do I go? It's the classical dilemma, or want to know that it's small cap versus big cap. Prashant, you are, I think, if I'm not mistaken, you are a big believer in PSU stocks. Then in terms of segments, is it the banks and the financial sector? Is it back to the limelight, or consumer goods, or auto, where? So if you can, Prashant, starting with you, can you tell us which are the segments one should look with a lot of positivity at this point of time?
So, Tamal, I'm a believer in all strong, sustainable businesses that offer reasonable value. And I don't distinguish too much between PSUs or private companies. And there are good and bad companies in both the spaces. And the list of failures in private sector is very long. And the list of failed businesses in public sector is also quite a long one. So I would say at this point of time, and to be honest, I mean, I also don't see much debate or divergence in long-term returns between the large and the mid-cap space. What happened between 2015 to 17 was an aberration. And when mid-caps outperformed, and the subsequent correction has taken out those excesses. I, for myself, in my judgment, see value still in some corporate banks. I see value in some public sector enterprises. One, because public sector enterprises have underperformed for two reasons. One, the ETF was not a very good instrument to my mind, and that is what impacted the valuations. The profit growth of these companies, PSUs, actually outperformed private sector between 2015 to 2019. That is now done away with. We are moving towards strategic divestment, which I think is a very good development for value discovery in this space. The second reason why public sector underperformed was they are mainly represented in the core sectors of the economy. There are no public companies in consumer, FMCG, or media, or software, or pharmaceuticals. And therefore, their performance was also impacted when the economy was not doing well. And as the economy is beginning to do well, I think they should also perform better. So I see reasonable value in corporate banks. I see good value in capital spending. And I see some good value in some companies in the power sector as well.
Okay, quickly, each of you, Rajiv, where do you see value?
I see the US technology space as being very, very attractive as compared to some of the high growth Indian companies. So whether it be the new age listings or even some of the consumer names. So consumer names in India for anywhere between 7 to 10, 15% growth are quoting it extremely high valuation multiples, 70, 80, 90. Whereas some of these large US tech companies are trading at anywhere between 20 to 25 times earnings multiples, very, very robust business models, and optionality on some of the newer businesses which they have not monetized yet. So this question was also asked in the previous panel, CEO's panel. So I would urge everyone to at least have some US technology exposure in their portfolio, either by way of hybrid funds or investing in something like NASDAQ fund, which a lot of the funds are offering today.
Where, Nilesh, quickly, where do you see value?
Yeah, in terms of the dissection on market cap side, I think, I mean, if you look at the multiples for large cap for normalized year FY23 and 24, it's about 20 and 18 times. Mid caps is just a shade below, almost similar, 19 and 17 times. So there is no large gap or advantage mid cap here. What we see then, it is like longer term allocation, let's say 2/3 to 3/4 should be in large cap and remaining should be in mid cap, because in India, large companies are also growing franchise and they have better return ratios, some of them. So it makes sense to have higher allocation to large caps. Second is on the sectoral preference. At this point in time, we would like structural stories at reasonable price of banking, consumer discretionary, which is the auto part within the consumer discretionary, insurance and healthcare. These four sectors I would call out, whereas sectors which are a bit frothy like chemicals, new age or consumer, I think it will be very, very stock specific, driven by merit of individual business.
Thanks. Manish, where do you see value? Quickly.
I think given that we are living in a high inflation, low rate world, you have to buy financial and operating leverage, and most of the domestic cyclicals is where I see value, whether it's banks, NBFCs, cement, real estate. Only disclaimer I will give is that the moment you see CAD going over 3%, you have to change your stance.
Lakshmi, I know you are not an equity person, but in the debt space, what's your take?
One space which we really like, I did mention about state development loans on the pure fixed income side, but one space we really like, and it's something which investors should keep as a reckoner on their chart, is REIT. Same trade, you know, the inflation come back, the demand for real estate, the coming back of commercial demand, all of that, we believe will bode well for these. So that's another category which investors look at.
Last toast is yours, Naren. Why do you
So
see
we've been
value?
liking asset allocation and flexi cap and sectorally banks, pharma, telecom, power, etc.
Bank seems to be on the radar of most of you. We are coming to an end almost. I just want to ask you one last question. Each of you, tell us. I mean, I don't envy your job now because there is so much of regulations. So my question to you is this. In fact, we discussed this in the first panel, the CEO panel, but that was regulation for the market. Like how do you fight cryptos, which is far easier. I can have on my, as an app, and I can keep on pouring money there, etc., etc. But as a mutual fund managers, you see your phone is being recorded, your clawback, where do you invest, so on and so forth. So if given a choice, I would rather go and manage a treasury, bank treasury. What is the incentive to become a mutual fund manager? I mean, do you see it is little overdoing by the regulator? I'm sure that you will not be forthcoming, but my job is to provoke you. Do you think that it is it's time to relook at some of the regulations and the norms that have come of late? Do you think it constrained them as fund managers? Naren, you are smiling. You are nodding. I think you agree with me. So we'll start with you, and Lakshmi with the last speaker. Yeah.
Certainly, we would always be happier with looser regulation. But, when you work in ICICI mutual fund, you get the ability to touch people from Kashmir to Kanyakumari and from Guwahati to Dwarka. That opportunity you won't get if you do bank treasury. You'll be managing money of 1%. So, the kind of advantage or the kind of ability you're able to touch by handling the money of millions of people has been phenomenal for us. When I joined ICICI Mutual Fund, we used to manage 2,000 crores of equity money and maybe 10,000 crores of overall AUM. From there, we reached, as you mentioned, 4,60,000 crores. And I think that 4,60,000 crores can go to 10 lakh crores also very easily. So that joy is there, that you're able to touch a lot of people. And I think we are managing the capital allocation of this thing. Of course, the lighter regulation and some of the regulations which we think, we are also public servants. We also have to manage money well. We also have to handle things in the right way. So we would always request that through media, if you can let us get easier regulation, we will always be happy. And I'm sure, Tamal, you can do it for us.
Okay, that's not done. So, but anyway, anybody wants to add anything? Yeah.
Yeah. Yeah. So go ahead.
Yeah, Manish, yeah. Go ahead.
So I just think that it's part of the job in the sense that, just as an analogy, right? I mean, we are kind of McDonald's, right? The big asset managers, and there is always a Thai restaurant or a Lebanese restaurant which will have its own cake. So if you're a McDonald's, you will obviously live with different regulations than a Thai restaurant or a Lebanese restaurant. So it's just part of the landscape, I think.
So you are happy, Nilesh? Yeah.
No, not much to add. I mean, it is a job of an enormous sort of fiduciary responsibility, as Naren also mentioned, millions of investors and a large room to grow. So, yeah, I mean, ideally one could have some lax regulation, but in the overall context, I think it's fine. So there are pros and cons here.
Yeah, anybody wants to add anything?
Yeah, since you were trying to provoke something, let me have a go at it. So, see, broadly, the regulation has been customer friendly, and while it irritates us for some time, but it results in industry growth. But sometimes I think the regulation should be more principle based rather than rule based. I'll just make an example of the skin in the game circular or the compensation circular. So I know Mr. Prashant Jain is part of this panel, and he puts a sizable amount of his savings in his own schemes. I have been putting a sizable amount of my savings in my own scheme for almost a decade now. It's not that something new that we are doing, but the new regulation is more rule-based rather than principle-based, where we will be forced to put money in liquid funds, which will give us a 3% return, and money will be locked up for 3 years. Now, I'm still okay with that, but some of my colleagues have home loans where they are paying interest rate to the bank at the rate of 8.5%, and they are also forced to put money in liquid funds at 3.5%. So, somewhat of a shift towards more of a principle based, where we are more tuned towards protecting investor interest rather than having very strict rules which are regimented. Some flexibility will help.
You said anything, Prashant GS said that you put your own money in your fund. So anything you want to add on this, all these lot of regulations, your phone will be tapped, the clawback clause, the money you need to invest in your own fund, anything you need to add?
There are always two sides to a coin, and whatever you do, there are some pros and some cons. And but I mean, I only hope that this 20% of savings which is going into funds, the managements increase our salaries commensurately, so that then I don't think anyone would complain.
Okay, Lakshmi, smiling, anything, any analogy from?
No, I just want to add to Prashant saying that either they increase or they give us interest-free loans, because I am with Rajiv. Small amount of leverage doesn't hurt on personal balance sheets, and when leverages are running, Rajiv, by the way, Kotak Bank home loans are at 6.55, so you can ask your colleagues to shift there, not pay 8%. But aside of that, running leverage at 6.5%, 7%, and investing a sizable chunk at 3.5% entails a negative cost of carry. You have to get used to it. We don't have that choice right now. And as long as far as the phone recording is concerned, everything that happens in market hours and off market hours, which is business related, obviously is in the right post. So if the regulator does not have any issue listening to, people like me giving philosophical gyan to my son, or talking in a belligerent tone with my spouse, I think it's absolutely fine.
Okay. Well, with that note, so let's take a few questions. So what we discussed, the discussion was markets buy, sell or hold. So I think all of you agree, no, certainly not buy, definitely hold, certainly not, I'm sorry, certainly not sell, definitely on hold, and buy, but be little careful about what you buy. That's what you are saying. You see the valuation issue not in the overall market, but in certain pockets. You have your concerns about certain new age entities in the IPO market, etc. But you are saying that overall you are pretty okay with the market valuation and the direction of the market. And all of you believe that India, a lot of things are happening, the structural reforms, corporate balance sheets, deleveraging, bank balance sheets, less NPA, everything, it's for the better. So there is no question. So market is on a high, yes. There is exuberance, yes, but not all over the place. It at some certain pockets. So as long as you are careful, as long as you are judicious, so you can keep on holding and adding to your portfolio. Definitely not a time to sell and stay liquid, right? If anybody, if I'm not summarizing it correct, please correct me. Anybody tell me if you have a different point of view. Otherwise, this is the key message. That's the 6 fund managers of India's large fund houses just now have told us. So it's buy, selective buy. Use your discretion. Don't get carried away. There is exuberance, but not all over the market, only at certain points. So you have to be careful about that. Let's take a few questions. There are many. Unfortunately, we will not be able to take all the questions, but let's take one. Is this? It's talk about the non-traditional companies or the new age company. How are you building competence at your mutual fund to analyze, invest, track these companies? Who wants to answer? Rajiv, I'm seeing you are nodding. You want to say?
Yes. So
one is avoiding, and other part is this not avoiding, but building your own competence to analyze these companies. As Nilesh says that, everybody can't be Amazon, but today we can't say that. Probably over a period of time, there would be some interesting companies out of not everybody. So how do you track them? How do you analyze them? Rajiv? Yeah.
Absolutely. So we have analysts covering these newer sectors as and when the companies are established, and sometimes we have analysts covering companies even when they are not listed, even in a unlisted kind of business case. So all of these internet-based companies, we have in-depth coverage. We also do on-the-ground work, and also we give talks on these on a monthly basis, and we record them and put it out there. So we get feedback from viewers via social media or via email, where people discuss, debate these newer companies with us. Some of them are people who are actually working in the sector. So it's not that we simply brush away complete sectors saying these are overvalued. We need to keep refreshing our skills and evaluating the newer sectors as and when the businesses are set up.
Well, there's a question somebody is asking, a gentleman called S. Kumar. India's retired population is set to rise 41% to reach 19.4 crore by, it's a decade later, 2031. Farmers account for a significant part of the population. Are there mutual fund products tailored to suit them in addition to the millennials and urban population? It's talking about mutual fund products for farmers, mutual fund products for retired people. Naren, Prashant, since you two run large companies, want to say something?
Actually, you know, as far as people who are in the zero tax bracket, I think government has very good saving schemes actually, like the RBI bond and government saving schemes. They pay interest rates much higher than what even banks pay. They should be considered by them. As far as the other people is concerned, most of the asset allocation products that are there and many of the hybrid products that are there, they're well suited for actually retirement solutions. And over the years, we have spent a lot of time popularizing hybrid products and asset allocation products because they are more suited for retirement than pure equity. And that's what we've been doing at ICICI Prudential.
Prashant, you want to add, or others? I have one question for you, unless you want to add something here. You want to add?
I'm fine. Let's go to the next question, please.
Okay. This question is, it's saying global holding period for stocks has fallen from 8 years in the past, in the past 5 decades or 6 decades. 8 years in 1960 to less than half a year in 2020. I don't know the source of this information. What has been your average holding period for stocks? How it has been changing?
I think, Tamal, this is a very good observation. And why, go so far, you just have to look at the stock market turnover composition in India. Virtually the entire turnover is in F&O now. And so I don't think you have to, I would be surprised if the numbers are any different, or they will be similar in India. In fact, the F&O turnover is truly amazing what's going on right now. I would say that our holding periods are one of the longest in the industry, and this is based on, I think, public data, because mutual funds publish their turnover data. And I can say with confidence it is higher than others, but I don't think there is a fixed number which one can quote. It would change from year to year, and it would also vary from individual fund manager to individual fund manager in the same company. On an average, I would say our holding period has been between 2 to 3 years, but that's a very broad ballpark kind of number.
Okay. Yeah, thanks. I will take quick 2 more questions. That's it. 1 minute each, so 7:15 will close. Probably Nilesh or Manish, whatever you answer. Warren Buffett is sitting on a record amount of cash. How easy or difficult for you as an Indian fund manager to find bargains in the current market? Yeah.
So if I may start, I think in our business, answers are tough, but you have to ask yourself the right question. So at least as a mutual fund manager, the way we think about it is we have to beat the benchmark and not worry about absolute returns. So basically, most of our diversified fund, we will never take a very large cash call, very simply put, because we don't think that is our mandate. We think that investors have given us money as part of their equity allocation. And therefore, taking a cash call, to my mind, is not our mandate.
Okay, let the lady have the last word in this thing. The question is, it was an actually old question. I'm repeating. It was asked at the CEO panel also, referring to a Mark Mobius' recent comment that India is on a 50-year rally. So Lakshmi, probably you can give us a dialogue of, I don't know, Gabbar or whoever you want to counter it or to second it.
No, I think I was part of that panel where I heard all the other views also opine. I think the views no very different. You need to asset allocate. You can't let your dharkan be dictated by the halchal in the markets. And in typical Bollywood style, there will be khushi kabhi gum moments, but you have to have the hum saath saath hai feeling, and that should give you the kick of being invested. And then you really don't care what happens after 50 years or what's going to happen in the next 5 years. I think that's what is most important. I don't have the stature of Mark Mobius, so I don't really want to qualify statements on this.
Thanks. Thanks. Actually, you summarized the entire discussion. Buy, sell, or hold. You said it's kabhi khushi kabhi gum, and hum saath saath mein hai. So mutual fund there is with you, and that's it. I think we have a rather entertaining discussion. I don't know whether we could answer all your questions, but we tried. That's the end of it from my side. And tomorrow is the Big Bang, the grand finale, where we will start with a conversation with the Reserve Bank of India Governor, Mr. Shaktikanta Das, and then the biggest bankers in India will have a panel on the current affairs in banking. Half an hour before the scheduled time, not 4:30, at 4 o'clock sharp will start. Over to you, Manish. Thank you. Bye from my side.
This concludes the penultimate day of BFSI Insight Summit. Many thanks to all our panelists. Thank you, SBI Mutual Fund and Jana Small Finance Bank, our partners. Thank you, dear audience. We've come a long way, and like Tamal said, the last day of the event series promises an insightful finale. I'm just repeating again. We will start at 4 p.m., not 4:30 like the other days, with a fireside chat between RBI Governor Mr. Shaktikanta Das and Tamal, followed by a panel of India's biggest bankers. That's all from us for now. Have a great evening. See you tomorrow.